So today let's start with what? Tell me. IHT. I think yesterday we were done with individuals, right?
Yes, sir.
So today we are going to do what? IHT. Inheritance tax. Right? In inheritance tax, basically there are two types of taxes, correct? One is a lifetime tax on gifts given by an individual to individual or trust, correct? And the other is what? Taxation during death. In death also there are two taxations. I hope you remember. Tell me. Chalo quickly. What are the two taxes? Tell me. During death, two taxes are there. What are the two taxes? One is on the lifetime gifts. Death. On the event of death, what happens? Tell me. Lifetime gift taxes or lifetime taxes there on the gifts given during lifetime, correct? And after that, there is something called as death estate taxation, right? In that you have all the things, correct? Oh, second. चलो आ जाओ. So now let's go one more step ahead, right? So inheritance tax IST during lifetime of a person, correct? So for a person who's giving gifts, right? The donor and the donee. Donor is one who gives all the gifts that are there. Donee is one who gives what? Or tell me. Who sends what? Tell me. Who receives all the gift, correct? So then whenever there is an IST during lifetime, there are three types of transfers or gifts that are done. One is a fully exempt transfer, correct? Between spouses, whenever a gift is given by a husband or spouse one to spouse two, correct? Or civil partners also, correct? Right? So in that case, what will happen? Tell me. Gift between spouses are fully exempt, right? It is a specific exemption, right? It is also called as what? Specific exemption. There is what? Fully exempt transfer, right? Then there are PETs or potentially exempt transfers. Whenever an individual gives anything to an individual, it is called as a PET. What is it called? PET, right? It is called as a PET, potentially exempt transfer. It is a PET and exempt during lifetime of an individual, but taxable on death of an individual, correct? So on death, these become taxable, right? Then there is something called as CLT. What is it called? CLT, right? I have given these notes to you yesterday only. Tell me. I hope you have these notes. Yes or no?
Yes, sir.
Yes. So PET, CLTs, correct? Potentially exempt transfers and chargeable lifetime transfers. CLT is individual gifting anything to trust is a CLT, and in lifetime it will be taxed. But after going through the test of what? Specific exemption and annual exemption. There are two types of exemptions. What are the three types? One is fully exempt, correct? Between what? Your husband and wife or spouses, correct? So have a look. Mr. A gives 700 pound to Mr. B is a PET. Mr. A gives 10,000 to a trust for Mr. B, son of Mr. A, correct? It is what? A CLT. Mr. A gives 5,000 to wife, fully exempt transfer, right? Then you have what? Exemptions on PET and CLTs, correct? First preference is always given to what? Specific exemption, right? Specific exemption. So whenever you get a transfer of value, right? First is transfer of value, right? From one person to another. When I say gift, correct? The transfer of value happens at generally the market value of the gift as on date of gift, correct? So gift between spouses, right, are fully exempt. And when it comes to small gift exemption, correct? So small gift exemption is what? If gift of less than 250 pound per person per year, right, is given to any person, it will be exempt. Less than 250. If it is more than 250, fully taxable gift, correct? So small gift exemption is there. So first transfer of value, you utilize first the specific exemption that you have against the transfers. Then it is what? Tell me. Going to the second preference. So first preference is always to specific exemption, and in specific exemption, first exemption is fully exempt of what? Gift between spouses. Second is small gift exemption if the gift is less than equal to 250 pounds, correct? For a tax year per person. If gift is greater than 250 pounds for a tax year per person, it will be fully taxable, correct? Then gift in consideration of marriage, right? Now, if you are a parent of a person who's getting married and if you gift him 5,000, Up to 5,000, no tax. Correct or not? Tell me. Above 5,000, right? It will be what? Above 5,000, correct? It will be taxable. So let's say 10,000 gifted minus 5,000. But sir, 250 less than 250 fully exempt, correct? More than 250 fully taxable, correct? Keep that in mind, right? Gift by parent up to 5,000 it is exempt, right? Gift by grandparent, your grandparent giving it to your grandchild, correct? Fully exempt, right? Up to 2,500 fully exempt. Above 2,500, whatever it is, it will be taxable. Gift between each other on the day of marriage. There is also a concept where they ask that was gift is given by what? Husband to wife, but one day before marriage, or let's say on engagement, or gift for engagement by parents and grandparents. This applies only for marriage, does not apply for what? Tell me. Does not at all apply for what? Tell me. Anniversary not allowed. Then engagement not allowed. Then normal expenditure out of income. Example, pocket money or expense for maintaining basic standard of living of donee. Correct? Basic standard of living of donee. Okay. That is how it is. Right? So these are specific exemptions. So whenever you get a gift, first verify whether any specific exemption is there or not. Tell me whether you all checked the notes and tried to solve the question that I had given in the notes. Most of the questions I tried to cover in the notes, right? Then have a look. 5,000 of Mr. B.
These notes are not shared. For this PDF is
I
not.
have shared. I shared both the notes, no? Wait, not shared?
No, it's not there in the group.
Yes, sir, you have shared that. These notes are there.
There or not there? Wait. कर देंगे ना नहीं है तो. Have a look. I'll have to close them because I have to rename them. Chalo, I've shared them now. Wait, I'll share the other notes as well. So we are done. So whatever we are going to do today, all notes I've shared with you as of now only. चलो आ जाओ. So we're done with this. Now let's go ahead. Correct. Exemption on PT and CLTs, right? This is done. Then you could have a look at all the questions, right? That 5,000 on event of his marriage, correct? So 1,000 for anyone, right? So 5,000 for friend. He is not your son, grandson, or anyone. And these exemptions apply to donor, correct? So donor taxation happens in the hands of the donor, right? So have a look. Gift to son on account of marriage 7,000. 5,000 will be what? Exempt, correct? 2,000 will be taxable. But right now will it be taxable right now, or is it a potentially exempt transfer as of now? As of now, it is potentially exempt transfer. So no taxation arises during lifetimes on any cash gifts or any gifts made. This is somehow the format of how to solve the question. This may be not very important because the section C question is not asked on this, right? A section C question is not asked on this. So maybe, correct? Maybe it so may happen that the format may not have a lot of relevance. But if you follow the format, if you know the format, then there are chances that you will not make a lot of mistakes while calculating what? Taxes and taxability. There will be a easy way to do it. So transfer of value 7,000. You have a specific exemption of 5,000. After that, you have something called as annual exemption. Have a look what is annual exemption. First preference to specific exemption. So always ask yourself when there is an individual to individual gift, correct? Generally specific exemptions will apply. If there any specific is there any specific exemption that applies? Yes. If there is a specific exemption that applies, right, then apply that specific exemption. Then whatever is remaining on that, apply the second preference or what, the annual exemption. For both PETs and CLTs it is available. But when it comes to specific exemption, generally it is only available to what, PETs, only PETs, and second preference PETs as well as CLTs. CLTs means what, gift given to trust. So now have a look, this question I have taken, gift to trust for son of 1500. In that case what will happen, no specific exemption, correct? First was gift of what, to son on marriage. On this you got 5000, what, tell me, exempt, right? Here there is no exemption. Have a look. Here CLT also has no exemption. This 6000 last transaction, gift to daughter on graduation, this has no specific exemption, so 0, right? Then you have chronologically whichever gift comes first, right? You can use AE of current year. AE every year, current year of 3000 AE is available to you. Have a look. AE amount for tax year 23-24 is 3000, applicable date wise. If two gifts on different dates, AE will be available chronologically date wise. FIFO. Unused AE of a year can be carried forward for 1 year only. First you should use current year AE and then brought forward AE. Now whenever there is a word given in the question that was this is the first gift of that person's life, this 7000 is the first gift, let's say, so what will happen, the gift before this and gift after this, correct, or year before this, the AE will be unutilized because this is the first gift that is given, correct? So what happens, have a look, this 2000 year used, correct, and this 500 from last year you can use, right? This is how 22-23 you can use 21-22 because it is the first gift, so 21-22 unutilized, so I can carry it forward and use it in this year. Have a look, makes sense, tell me? Yes. Then this transfer of value of 1723, correct, 4000, against this also AE available, tell me? Yes, full 3000 you can use that amount for sure, correct? So here 3000 of 23-24 is used and 22-23 utilize everything, so 0 available. Have a look. Because so first what you'll do, first you'll write whether it is PET CLT, then you'll write the date of what, the gift, then is it a what is the gift, then transfer of value, what is the value, then specific exemption, from that you will deduct AE. I even have a Excel format of this, have a look, that will also help you in exam. Something like this, a format is to be made. Have a look. Marriage of son, correct, you have a specific exemption of 5000, correct, 3000 is value of gift after, or 5000 will be value of gift after specific exemption, correct, this minus this, right? Then you can use annual exemption of 12-13 of full 3000, correct, and here you could use 2000 and 0 is the balance. That balance only will be GCA or GCT amount. So have a look, you have a CLT 1000 is there, 3000 0 3000, correct, this is GCT or GCA, we'll come to GCT or GCA, correct? So the only googly question that is asked in exam is it is a first gift, so in that you have to remember not only 3000 of current year but 3000 of last year can also be used because it is unutilized, correct? Then you have something called as a lifetime nil rate band. Lifetime nil rate band of IHT applicable only to CLT, right? Applicable only to CLT after all exemptions, right? So whenever there is a CLT, correct, you reduce what? Tell me. A proper part out of it, correct? So what do you reduce? Tell me. From CLT, right? You reduce AE or annual exemption, specific exemption, annual exemption. After that, whatever is left for CLT, the only annual exemption is there, right? Then the lifetime nil rate band is nothing but the amount on which you don't have to pay tax, correct? Up to 325,000 for a 7-year accumulation period, you don't have to pay tax, correct? Utilization calculation should be based on GCT or GCA, correct? Of last 7 years. What is GCT or GCA? Tax payable. We'll come to what is GCT or GCA. Tax payable on CLT over and above the NRB, correct? Tax paid by donor, 25% will be the rate. If tax paid by trust or donee, it will be at 20%. correct? Have a look. GCT or GCA in this case will be balance after exemption plus the tax paid by donor. GCT or GCA in case of donee will be the balance after exemption. How does this go? Have a look. I have written the procedure. Correct? What you do for lifetime nil rate band? Have a look. There is a question here. I have drafted a good question. Now see, Sun PET. Have a look. What is it? 9,000 on event of marriage. So remaining 4,000. 3,000 of 1213, 11, 12, 1,000 used, correct? Then 1/4/2013, correct? There is another. Now 1/4/2013, will it go in tax year 1213 or 1314? Tell me. 1/4/2013, where will it go? Bolo, bolo. Where will it go? Tell me. Where will it go? Bolo, bolo.
1213.
1213. हाँ, so 1213 में 3,000 of 1213 already used here, right? And 11 12 का remaining 2,000 can be used here, right? It is a daughter PT on her graduation, so 2,000 used, 3,000 is balanced. Now no taxation in this case, so direct taxable value is 3,000, but fully exempt, so tax payable will be 0, and gross chargeable amount or chargeable amount is going to be 3,000. Generally chargeable amount is nothing but the balance after all exemptions, correct? Balance after all exemptions, right? So this 3,000 is only GC or GCT. Then coming to the part of CLT, 65,000 worth of CLT you are done on tax year 14-15. Now 14-15, so 14-15 ka 3,000 can be used, and no gift in 13-14, so 13-14 ka 3,000 will also be used. So your balance is how much? 59,000. This should become your GCT if no tax is payable. So 59,000 only becomes your GCT, because in this case, out of the 325,000, so what you do? For calculating the utilization, you go from the date of gift, go back 7 years and see whether any gifts are made. If any gifts are made, you take the GCA or GCT amount of the gift, correct? GCA or GCT amount of the gift and try to what? Utilize it here. But here when you went back 7 years behind, there was no CLT. This only happens against CLT utilization, right? But come to the next gift, right? Now this 59,000 will only become what? Your GCT or GCA. Gross chargeable transfer or gross chargeable amount. Now coming to 59,000, next gift, then I did 150,000 on 1/1/2016. पहली बात 1/1/2016 tax year 15-16 or 16-17. Tell me. 15-16 or 16-17?
15-16.
15-16. Correct. Once 15-16 is there, correct. Then have a look. 150,000 में से 3,000 of 15-16 deducted. 14-15 is there anything remaining? Tell me. Fully utilized. Correct?
Yes.
So 147,000 remaining after all what? Tell me. Your exemptions, correct? So 147,000 is there, correct? Now what you do? 325,000 is the nil rate band. You go back 7 years from here, right? So what is the date? 1/1/2016. Go back 7 years. When you go back 7 years up to 2009, is there any CLT? Ask yourself, is there any CLT? If there is any CLT that is there, correct? Then utilize the CLT. But should you utilize this 65,000, this 59,000, or should you use the below GCT that you have calculated? You will use the GCT that you have calculated, correct? Have a look. Then you have what? 59,000. How much is available? I think more than 147,000 is available. So can you use this 147,000? Yes. So you utilize this 147,000 and their taxable value is 0, correct? Taxable value is how much? 0. So tax payable will be 0. 147,000, that is your balance, will only become your GCT. Have a look, right? Then going ahead, this now gets interesting. See, देखो, right? ये 94,000 again same thing happened, but come to this 147,000 CLT है, correct? 150,000, correct? 3,000 का AE, correct? You have 147,000. Abhi, now stay very vigilant, right? Out of this 300,000 is utilized. How? Have a look. 3 GCTs in the last 7 years. This 94, 147 and 59. So you have utilized how much? 300,000. How much is not utilized? Tell me. 25,000. So how much is taxable? 147 में से 25,000 can be utilized. 122,000 is taxable. On that, right? Ask yourself who pays the tax. This is 1/1/2019. Go to 1/1/2019. Who pays the tax? Tax paid by whom? Mr. A means donor. If donor pays the tax, have a look. What should be the tax rate? If donor pays the tax,
25%.
25%. Then we calculate what? 25% on this. 25%. Where is the 25%? Have a look. 122 into 25%. Now, when you are doing GC or GCT calculation, it is what? That balance amount 147,000 and over and above the donor. So, donor what he does? 150,000 he gave, correct? 147,000 is his what? After exemption value. On that, he pays extra 30,500. That means the GCT value or GCA value is 147 plus 30,500, that is 177,500, correct? Then coming to the next part, daughter marriage, okay, this is okay. Trust CLT again, 150,000. You go back 7 years, 271 is used, correct? So go back 7 years and utilization will be what? Only GCT, correct? Now all this, whatever I said, correct, is written what? In a procedure. Identify whether gift is PET CLT. Then if it is PET, you will deduct any specific exemption and then any annual exemption if available. Balance, right? And available balance. Then if it is CLT, you will deduct only annual exemption, right? If available balance, correct? You go from what? There to balance, correct? Then if it is a PET, if it is a PET, balance after specific exemption and annual exemption is available, or if available will be GCA or GCT, correct? If CLT, get the nil rate band amount available, deduct utilization of last 7 years from date of gift as GCTs of the utilization. If anything remaining, utilize against what? If anything remaining, utilize against the balance and get taxable value. From the taxable value, calculate tax at 25% or 20%. If donor pays tax, then 25%. If donor pays tax, 20%. Correct? Now, GC or GCT will be what? In case of donor, you have to pay tax over and above. So, whatever balance plus the tax. And if it be donor, then balance only is the GCA, because donor is going to pay the tax from the amount they have received. A pura what? The whole procedure in 4 points. If you read this, 90% of your problems will get solved. If you sit with this and solve questions, more than enough, right? Life is sorted, correct? So go ahead. If nothing is mentioned about who will pay the tax or CLT, then the basic assumption is that donor will pay the tax, correct? Date of payment is what? If CLT is made within 6th April to 30th September, right? Then all of that cut tax will be paid on 30th April of next year, correct? So if CLT is between 1/4/23 to 30/09/23, correct? Payment due date will be 30/04/24. If it is made after September, that is October to 5th April, correct? Then 6 months from the end of the CLT. So let's say if you have done 1st October 2023, the date of CLT is 1st of February 2024, then 6 months from there, 31/08/2024 will be your payment due date. Has been asked in exam before. It is a favorite question of the examiner in section B to ask you that, boss, what will be the value of what? Tell me. What will be the taxable value? And the other, when will the payment be made, correct? Then diminution in value, right? Diminution in value, valuation of gift, correct? A lot of times your transfer value, that is the first line, cannot be, see, simply if I give you cash, then the value is very clear. But if I give you shares, correct, where I had 80% shares and I gifted you 40% shares, when I had 80% share, I had substantial control over the company. But if I gift you 40% or 50% shares, out of that 80%, I lose substantial control of the company. So I will do what? What was my value of gift at 8,000 shares, correct? And minus the value of gift after the gift is given, or value of asset after the gift is given. So at 30%, what will be my value, and 80%, what will be the value? Difference will be the gift given to you, correct? Check one question out of this, correct? Have a look. Diminution in value, value of share or asset before gift, and value of share or asset after gift, correct? Then, wait. Death estate गायब. अरे, wait, I'll get the death estate part. Just a second. Where it went, corporation tax. Where did it go? Have a look. Do you have the death part? Don't worry, I'll give you these many pages differently. Aja, up till I think Aja. Till here we were done. Tell me. Aja, उसके बाद IST implication on that. Now see, lifetime taxation is done. Now we are going to go into what? Tell me. Your IST implication on death. On death, I said what? Two things are there. IST on lifetime gift on death, correct? IST on what? Lifetime gifts on death and IST on death estate, correct? So IST on lifetime gifts on death, have a look. So whenever, now see, lifetime mein to on CLTs you are paying tax, but if you die, right? Not you, but whoever the person who has given gifts, like we were doing this example in Excel, right? So if this person dies, I have also taken that scenario. Date of death of person is 3103, how much? 2024. Then the first thing that you do, right, is what? Your lifetime gifts get taxed, right? Your PTs that were exempt become taxable. So first thing that you do is what? Go back 7 years. Simon, go back how many years? 7 years. From the date of death. All the CETs and PLTs in the 7 year period before that are fully taxable now. So any PTs older than 7 years will never be taxable. So it is a joke that is said that whenever you have a look at what? Tell me. In IST, right? Pray that whoever gives you a good cash gift, correct, survives at least 7 years, or else it will become taxable, right? But before the 7 years, if there are any CLTs of more than 7 years old, they are not taxable but can be used in death, nil, dead band utilization. Again on death, you get a renewed 325,000 limit, correct? So what did I do? Have a look here. What did I do? All these PETs and CLTs were there, correct? So I went 7 years from the date of the death. So that is how much? 1417. So these CLTs are not taxable but are kept in calculation for utilization purpose, right? So when you go back 7 years, this CLT ka utilization will be used, right? So what you do? First, 7 years I have done green year. Have a look. These are all gifts that are taxable. Older than 7 years, these were the PETs. They are never going to be taxable at all, correct? Have a look. So I blacked them out because they are not taxable at all, correct? These CLTs, right, are not taxable, but in the utilization, because it says what? At every gift, have a look. So now start taxing the earliest gift. So we go here. The earliest gift is this CLT, correct? And from here, go back 7 years, right? Right, you have a DNRB of 325,000 with your utilization will be from date of gift to 7 years before, include taxable PETs and all CLTs irrespective of whether taxed or not. So these are not taxable PETs, these will not be included, but CLTs will be included. इतना दिमाग लगाना पड़ेगा, correct? Gross chargeable GCT or GCA, correct? You have to take from lifetime and start the taxation on this GCA or GCT amount. That is why GCA or GCT amount is very important, correct? So include taxable PETs and all CLTs irrespective of whether taxed or not. Then tax the unutilized amount, whatever is the unutilized amount. See, here I utilized 94,000 fully, so no taxation. But if there is an unutilized amount here, taxable amount, 25,000 utilized, 150 to 500 taxable. On that, directly calculate tax at 40%. Then comes taper relief concept. Taper relief means, see, if it is an older gift, it should not be fully taxed, right? So look at the year. This taper relief table is generally given to you. If the gift is 3 to 4 years old, only take 20% relief. 4 to 5 year old, take 40% relief. 5 to 6 years old, take 60% relief. And 6 to 7 year old, take 80% relief, correct? Have a look. So here it is what? Tell me. 18, 19. I have drawn a table also. How many years old it is? Have a look. 1, 2, 3, 4. So within 4 to 5. This was within 5 to 6. So we took how much? 40% as taper relief. Have a look. Here. 40% we took because it is 5 to 6 years old. Correct? Then remaining. How much is taper relief at? Somewhere around 60%. Correct? Then you have what? Also from this, you have to deduct tax already paid during lifetime. If you have paid some tax in the lifetime, you don't need to repay the tax during death. So these two things are there, and there can be never be a refund because of this. There can be tax payable, but no refund, right? So have a look, taper relief. Then deduct tax paid in lifetime on gift from the IST at 40%, arrive at IST payable. Correct, IST at 40% minus taper relief minus tax paid in lifetime. No refund allowed. IST is to be paid by donee on the gift due date is 6 months from end of the month in which donor dies. Correct. After that, after using all this for 7 years and doing all this, right? After taxing all the lifetime gifts, if there is any death nil rate band that is remaining, that only can be used against death estate. What is death estate all about? Have a look. Death estate. Yes, Tahir, tell me.
Sir, taper relief is calculated on what amount? GCA?
No, it is calculated on tax amount. 60% of tax, 40% of tax, or 20% of tax. So have a look. What did I do here? When I calculated taper relief, have a look. I calculated on the tax, and 20% or 40%, 60% or 80% of the tax will be a relief that will be given to you. Right?
Okay, okay.
Then going ahead, we have what? Tell me. IST on death estate. Have a look. In the death estate, you have a lot of things. You have a freehold property, right? Freehold property, land and building, correct? If there is any normal interest mortgage against this, if there is an endowment mortgage, that cannot be deducted, correct? But if there is a normal mortgage, it can be deducted. Business owned by sole trader or partnership firms, whatever is the value. Stock and shares, government, securities, right? Insurance policy proceeds, right? Here you have to remember, you do not have to add insurance policy market value, but you will add what? Insurance policy proceeds, because the person has died. So market value does not make a lot of difference, right? Because he's already died, correct? Then leasehold property, motor cars, personal chattels. What are personal chattels? You must be knowing, but we'll cover in CG today, correct? Debt due to the deceased, correct? Has to be legally enforceable, cannot be what? Tell me hearsay. Has to be on paper, correct? Cash at bank, correct? Deposits that are there, including the cash ISA. From all the assets, you deduct all the liabilities, correct? Debts due by the deceased has to be legally enforceable. Outstanding taxes, credit card bills, income tax, CGT, whatever is due, everything. Funeral expenses, correct, of that person. Coffin charges, mourning clothes, and tombstone charges are allowed. After that, you have something called as exempt legacies. Then you have something called as specific legacies. In specific legacy, two things have to be very clear: specific asset and specific person, right? Both the things, if they are there, then specific legacy will be deductible. Gives you gross chargeable estate. From the gross chargeable estate, you deduct the RNRB and DNRB. What is RNRB? Resident nil rate band. That means if in your death estate there is any residence that is there, correct, that you are gifting to your successors, right? To your successors, that is your son, nephew. Nephew is also successor. Okay. Over and above that, you will get a death nil rate band, correct? Then you have the taxable estate on that 40%, and tax payable by not donor, because donor has died, but by the donee 6 months from the 6 months from the end of the month in which the person dies, correct? So have a look. There is a question here, right? Surely you can have a look. Then GC or GCT, ठीक है, हाँ. This is one type of question. If you have not seen, please see this question. Has appeared a lot of time in exam. तो उसके बाद डेथ नील रेड बैंड 325,000 is to be utilized. हाँ, no gifts were given. हाँ, death nil red band, right? Let's say you don't gift any main residence, but if you have a death estate, right, you have a death nil red band available, will be used first for lifetime gifts, correct? Obviously. Then if any amount remaining can be used against death estate. Death nil red band cannot be claimed more than GCA and cannot lead to losses. So death nil red band, let's say your GCA is 5,000 and your death nil red band is 325,000 available. Only 5,000 will be deductible. Because of death nil red band, there can never be what? Tell me. Losses, right? but restricted to 325,000 on death. Unutilized death nil red band of spouse can be transferred to other spouse, but the amount is not transferred. Percentage of unutilized is calculated and is applied to the what? So what happens? One spouse dies, he has full 325,000 that is not utilized, correct? Or let's say at that time the limit was only 300,000. He did not utilize the full amount, correct? So full 100%, that 100% you take. Let's say you utilize 40%, 60% is unutilized. 60% of the second spouse death, correct? Whatever is the NRB on that date, death nil red band, to that 40% will be multiplied. Have a look. Here we have done. Here you took 62.5% of the unutilized part of Mrs. A, correct? And used it against what? This 325,000 into 62.5. This is how it happens. You can read this, correct? Then going ahead, you have a residence nil red band. It should be given where on death when main residence is part of the estate and by will of that person it is transferred, because if it is not transferred to legal descendant, your resident nil red band will not apply at all. So these three are what? Tell me conditions. And third is what? RNRB available is 175,000, right? Have a look. RNRB. So RNRB cannot. So your main residence is 40,000. RNRB is also restricted to 40,000. You cannot claim more than the main residence. If the main residence is more than 175,000, you can claim maximum 175,000 of resident band. Right? It will reduce your gross chargeable estate. Correct? Then if there is an unused RNRB or RNRB was not there when the first spouse died, right? The percentage or 100% if there was no RNRB, because RNRB came in 2017. If the spouse died before 2017, right? And he has no RNRB at that time, so full 100%. So you will get, if you die or the person or the second spouse dies after 2017, right? And first spouse dies before 2017, full RNRB 100%. And unutilized after 2017 both the spouse die, unutilized can be used. You can have a look at this, correct? Value of house main residence was 75,000. Different questions I have done, right? Tax planning or skipping generation, have a look. If Mr. A died, correct? Now see, whenever what they are saying, skipping generation, tax planning. Now see, if you gift a house, right, to your son, then he will gift it to his son. What will happen? Taxability happens now, and when the first or the second set of person dies, right? So two times taxation will happen. So what they're saying, instead of you giving it to your son, then his son or him giving it to his son, if your son is well off, correct, directly a grandfather should give the house, so that two times IST will not be taxed, right? So grandfather should what? Give the house to the grandson only, correct? Have a look, makes sense. Instead of doing it twice, right, two times you have to pay tax, instead you just pay tax at a lower rate today only, correct? That is tax planning. Also tax planning is there, which says what? That every year CLT you accumulate, and in 7 years only once you do the contribution of 325,000. So you can enjoy every 7 years 325,000 lifetime nil red band. Then comes the part of VAT, right? VAT is an indirect tax, correct? Output VAT, input VAT, right? There is a system of what? Output minus input is your payable amount. If output minus input is what? Negative, then you get refund, correct? Have a look how the chain of VAT works. How the chain of VAT works, right? Now VAT payable or VAT refund. Have a look, right? Just a second. Just a second, guys. So VAT payable or VAT refund, correct? Every quarter when the VAT returns are made, right? This transaction or this calculation will happen. Then types of supply. There are three types of supply that are there. One is taxable supply, one is exempt supply, correct? And one is what? Supply outside the purview of VAT, correct? Have a look. Makes sense. You have done this. Tell me. In taxable supply, there are three rates. 0% rate, correct? 5% that is reduced rate and 20% standard rate, correct? In exempt supply, you have services or goods like, so VAT is applicable on both services as well as goods, correct? It is applicable on both services as well as goods, right? Then supply purview of VAT, outside the supply purview of VAT, what is there, right? So exempt supply, right? And goods that are outside the purview of VAT, wages and dividend, obviously VAT is not paid on wages and dividend, right? Then 0% is taxable, but the rate is 0%. That means anytime the rate can go to 0. Exempt are what? Not at all taxable only. If you want to make them taxable, you have to take efforts, right? Then in VAT registration, you have two types, right? There is a historic turnover test and a future prospect test. What does the future prospect test say? Have a look. If taxable supply in next 30 days is expected to be greater than 85,000. Now this limit has changed this year, correct? This limit has changed for June 2025, right? So my urge to you, whatever you do, kindly get through in this quarter only, okay? Because if you wait up till next quarter, right? Tension. A lot of things are changing. If taxable supply in next 30 days is expected to be greater than 85,000, then registration is compulsory, correct? But effective date of registration is what? Date on which you found out your expected sale of next 30 days is greater than 85,000. So what do? You got a big order, correct? 100,000. So you know now your sale is going to go in next 30 days more than 85,000, correct? Then registration is compulsory. Effective date of registration is equal to what? Date on which you found out your expected sale of next 30 days is greater than 8,500, right? So they ask you generally that what is the effective date of registration. Date of registration is from today only you charge VAT on all, and you have to intimate HMRC, right? You have to intimate within 30 days. Take this 30 days very seriously, okay? Right? Why I'm saying this is because 30 days you cannot say end of the month, right? It has to be 30 days, right? So future prospect test. Then comes your historic turnover test. What is your historic turnover test? Have a look. Look back cumulatively 12 months every time, right? After the end of every month of business, correct? If the last 12 months cumulatively taxable sales is greater than 85,000, it is then compulsory to register. Date by which the HMRC should be notified should be 30 days from the end of the month the threshold is passed, correct? And effective date of registration is the first of second month following the end of month when threshold was passed. There is a typical type of question that comes up in exam. This is the type of question typically that comes up in exam, right? So how does it happen? Have a look. If you have first quarter April to June 10,000 per month, 30,000 is the sale. So when you look from end of first month, you look 10,000, second month 20,000, third month 30,000. Then you go ahead, correct? 30,000 up to third month and fourth, fifth, sixth is 12,000. Then fourth month and if you look back 12,000, that means 30 plus 12, 42, correct? Then more 12,000, correct? That is what? 42 plus 12, 54. Then you have more 66, correct? 66,000 by the end of 6 months, right? Then you go ahead, correct? 15,000 every month, 61 to 81,000, and then 96,000. So somewhere around November end, your threshold has passed of 85,000, correct? Then what is the date, right? By which you should notify HMRC, correct? First is what? Determine the date when Mr. A required to register. So he is required to register on 30th November. He got to know that he needs to register. What is the date by which he should notify HMRC? Notify HMRC means what? 30 days. That is from 30th November, 30 days. 30th December. Don't write 31st December. This is the mistake a lot of students do. Huh? From 30th November, go at 30 days. It is 30th December. An examiner fools you in this, right? And then at the end, when will the registration be effective from? 1 month or second month or first day of second month, whatever you want to say. Second month after. So 30th November, Then which is the second month? December and January. Uska first day. That means what? 1st January 2024. Correct? Makes sense. Have a look. 1st January 2024. Then if not compulsory, it is not compulsory to register with VAT. If you think that the expected taxable sales is less than 83,000 in the next 12 months, then it is compulsory to register. If your sale or supply consists of only zero rated VAT goods, correct, then you don't need to register. With regards to above compulsion and non-compulsion, a person can, without the above clauses, even if he has lesser what sales, still can he, tell me, voluntarily register himself in VAT? Tell me, why not? He can do that, right? Generally, it is done to show that the business is a bit big and all that, correct? Then recovery of pre-registration input VAT, correct? Recovery of what? Pre-registration input VAT. What is pre-registration input VAT, right? Before you start your business, correct? If there is any input VAT that is there, right? Then how do we look at it? Input VAT on goods acquired before registration can be claimed if goods are in possession, right? Any input VAT on goods, right, of last 4 years can be there or can be claimed. If you have on the date of registration, if you have the goods in your possession and they are not more than 4 years or purchased within 4 years from the business start, then that input VAT will be allowed. Input VAT on services acquired before registration, any services within the last 6 months availed from the date of registration, correct? Then it will be an allowable input VAT, correct? You can have a look at this question. VAT inclusive amount, and if you have to find VAT, then you divide by 6 and multiply by 1, you will get the VAT amount. If it is a VAT exclusive amount, correct, then you do whatever is the amount into 20%, right? You will get the VAT amount. 20% is the ultimate rate, correct, of VAT. Then come to the part of what? VAT on sale of business, correct? If you sell a business, that is also a commodity or good, correct? VAT on sale of business is what? Business is transferred as a going concern. No significant break in trading, right? And same type of business is carried out after transfer and buyer is liable. That is whoever is the new owner is liable for VAT immediately. So when I say going concern, same business should be, or the business should be continued, right? There should be 1 or 2 years break is not allowed. 1 month, 2 months is okay. Same type of business carried out. That means before it was what? Let's say trading business of some metal. Then also afterwards also same business should be carried out. And buyer, the old as well as the new person should be liable for what? VAT, right? If all conditions are fulfilled, no VAT. But if any of the one condition is not fulfilled, VAT will be charged on sale of business. Now there are two options of registration. The old person can deregister himself and the new owner can do a new registration. Or else, what can happen? Old owner's existing registration can be transferred to the new owner, but all the liabilities of old owners will be transferred, correct? Then you have deregistration. Have a look, deregistration. 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 Have a look. On closure of business, trader shall deregister himself if you close the business, correct? And notify HMRC within 30 days of cessation of closure of business. This also could come up. VAT registration is cancelled as on date of cessation of business. Or let's say if your taxable supply fall below 83,000 and you want to deregister yourself, you can deregister yourself immediately or on a agreed future date, correct? Have a look. The non-current asset. Now see, whenever you deregister yourself, whether you're closing business or whether 83,000 or less, see, you have claimed some input VAT on some goods, right? And logically those input VAT, correct? You have utilized it, correct, against the output. Now you will not have output to use this input. And that input VAT logically is nothing but the payment you have to make to the government, correct? So you already utilized it. So that is wrongly utilized. So if the liability, right? So you will do what? All the input VAT that you have or all the goods on which you have claimed input VAT that is there, you will reverse as output VAT, correct? Right? Have a look. On which input VAT is claimed, account for output VAT on the same. If liability is less than 1000, then waive it all. If it is more than 1000, fully payable, correct? Time of supply has two concepts. there is a concept of BTP and ATP. What is BTP? Tell me. Basic tax point. What is basic tax point? Have a look. Basic tax point is date of delivery or handover, right? Or whenever service. See, in the terms of goods, correct? Whenever delivery is done or handover is done, that is the basic tax point. And in services, it is what? On the date service is provided, correct? Provision of service, right? So have a look. Service requisition passed on, service provided on. So your basic tax point is what? Service provided on. Then actual tax point. Have a look. Actual tax point. Correct. Actual tax point is what? ATP. Now see, actually when will the, now see why this ATP or BTP or taxation is important. Now see, example, right? The actual tax point comes out to be 5 or 6 July. You have a quarterly system, correct? And you have a quarter from April to June. You made a sale in June, but its tax point is in July. You are saved, no? That tax output what you have to pay when? Tell me. In the next quarter, right? So what happens? Have a look. Actual tax point is what? First step is what? Calculate BTP for goods date of delivery, service date of provision of service. Whether any invoice issued, right, or payment is received before the BTP. If yes, correct, the amount and the date on which the invoice issued or amount received will be the actual tax point. But if no, then ask yourself, if invoice and payment is not done before date of what? Basic tax point, then ask yourself whether invoice is passed within the next 14 days. If yes, then invoice date is equal to ATP. If no, then invoice, if it is issued after 14 days, then ATP is equal to BTP. Actual tax point is equal to what? BTP. Lot of questions here, right? We've done a lot of questions here. Lot of questions here. Have a look. I'll give you both the notes, don't worry. Time of supply, right? Service requisition. This is done. These are the questions. Have a look. I have done a lot of questions. You can have a look at the questions, right? Then let's go ahead. After this, what will be the tax point for goods sold on return purposes, right? You have a lot of people say you take the goods, you pay afterwards. Don't worry, correct? When goods are adopted by customer, right? So when the customer does not come to return and says, I like the goods, I'm keeping them, right? Or 12 months from date of sale. 12 months from what? Date of sale. If that person does not come, whichever is earlier is the tax point, correct? Then for continuous supply of service, electricity and all, date of invoice or date of payment, whichever is earlier. Higher purchase, it is basic tax point. Then you have two types of discounts, correct? What are the type of discount and VAT implication, correct? Type of discount and VAT implication, have a look, correct? Just a second. Hmm. So type of discount, whenever you give a trade discount, correct? Now what happens generally, let's say I do a sale, correct? I give a discount at the time of making invoice. No tension, because it is VAT will be charged at lower amount. But what if the discount is given later on? Let's say I pass a bill of $100, correct? And I say that boss, you will get 10% discount if you pay. 30 days is the credit period. If you pay within 10 days, I will give you 10% discount. Correct. In that case, how it should work, correct? Because the invoice value on which VAT will be calculated will be 100, but at the end that person will only pay $90 because 10% discount you're going to give. So how to handle that, right? Initial sale happens and VAT is calculated on full invoice amount. When early payment is received, the VAT can be reversed, correct? Two things or two ways you can reverse. One is what? Tell me. Through a credit note. You pass a credit note, 100 ka sale, 10 ka credit note, correct? And reduce the or reverse the VAT on that. Output VAT, right? 2000 and reversed 100, right? Through credit note, correct? Or include a statement on the face of the invoice. Or you do what? On the invoice you mark that boss, I had given the invoices of $100, but $90 is only paid. So the revised VAT is $90 into 20%, $18, correct? Have a look, makes sense. Then going ahead, see, like this, you write on the face of it. Okay, 500% discount is given, and this is how VAT will work out. Then VAT implication of what? Goods taken by whom? Owner for personal use, right? Purchase for business and input VAT claim. Then simple charge output VAT on replacement cost, right? If not purchased for business purpose, no VAT implication, right? VAT implication of goods, services and NCA gifted. If you gift goods and services to anyone, right? You are going to gift free of cost, correct? Goods and non-current assets, right? Sample goods, gift goods and non-current assets, right? If sample goods, no output VAT or nothing. See, when you're giving out gifts, right? If you're buying it, you're taking input. But when selling, right, you're not doing what, or selling or gifting it, you're not reversing what? Tell me output VAT, right? You're only taking input, output you are not what? Publishing in the notes only, or you are not doing calculation of that, correct? Right? Or recording in the notes, correct? So gift goods and non-current asset. If I gift goods or non-current assets to anyone, right? If it is less than 50 pound per person per year, no VAT. If it is more than 50 pound per person per year, output value will be calculated on market value or replacement cost. Services, free services. So we will not have VAT on what? Our F6 UK tax what? Revision batch, correct? Input VAT availability and non-availability, correct? Input VAT what? Availability and non-availability, right? Now have a look. Input VAT is available on all goods and services, correct? Input VAT entertainment of overseas customer and staff, input VAT is available. But if it is entertainment of local customer or supplier, input VAT not available. There, remember, only entertainment of staff is an allowable expense, correct? But here, in overseas, entertainment of overseas customer may be a disallowed expense, but VAT is allowed against that, correct? Then input VAT is what? Purchase of motor car, right? 100% business use, right? 100% input VAT available. But if the motor car is less than 100%, 90% business use only, then only 50% input VAT available. Leased car, right? I have written here 100%, but it should be 80%. 80 50%. Leased car pay directly 50%. Have a look. I changed it here, I think. Here, lie down leased car is 80%. 18, sorry, 50%. 50% input VAT available, correct? Then on leased cars, right? Then come to this part of what? Tell me. If goods or services are used partly for business and partly for personal purpose, right? Only business use percentage of input VAT allowed, right? Then car and its what expenses. Repair of car, irrespective of 100% or anything of business use, full 100% input VAT available. This is the biggest problem for students, fuel expenses, correct? If it car, company pays full for fuel, 100% input VAT available. But if it is less than 100% business use car, correct? If percentage of business use is given, right, then what? Whatever business use percentage is there, that will be there. But if percentage of business use and percentage use of or percentage of private use is not given, and three options are there. If full reimbursement done by user of car, that means, see, I'll tell you, I am employee, correct, and company has given me car, right, for my private as well as business use. I am not able to what? Justify or tell you that how much is business use or how much is personal use. So I say that, sir, how much was the fuel cost for the full year? They say 10,000, correct? I reimburse the full 10,000 to my employer, correct? No input VAT available to the employer. But if he says 10,000 is the cost, I say, no, sir, I will only give 3,000. No problem. 10,000 input VAT minus 3,000, that is there, correct? 7,000 input VAT you can take. Then last but not the least, if no reimbursement done, right, the company can claim input VAT and you can have a minus scale charge. The scale charge will be given to you. Scale charge is always inclusive of VAT. So you will do scale charge into 1/6. Now see, I may tell you as much as I want to tell you here, but till the time you don't look at one of the question, life is always going to be a bit difficult, correct? Have a look. Mr. A bought 3 cars in the year ended 31/03/2024. Car 1 has been bought for 15,000 and it is used 100% for business use. Repair of the car is 1800 pounds inclusive of VAT, correct? Running expenses, fund and other charges, right, are 6,000 pounds. Now it's a 100% business use car, correct? So 15,000 pay whatever is the VAT will be fully available to you, right? 15,000 pay 20%, that is 3,000. Repair is also fully available to you because 100% business use. 1800 into 1 by 6, 300 pounds. Fuel charge also 100% business use, 100% fuel charge available to you. 6,000 is inclusive of VAT, into 1 by 6 will be VAT amount. Come to second car. Car 2 has been bought for 21,000 exclusive of VAT and is used 70% business. You know the 70% and 30% business use, correct? Repair of cars is 600 pounds, correct? Then exclusive of VAT, running expenses and other expenses 7,200. Now come to car 2. What is the answer for car 2? Have a look. Car 2. Input VAT on purchase 2,100, correct? Only 50% available because is the car used 100% or less than 100%? Less than 100%. तो कितना मिलेगा? Even if 70% used, input VAT on purchase only 50%. But repairs fully available, 100%. 100% available. Repair you have a 100% business use or less than 100%. Pura available, correct? Then fuel. Fuel may you have what? 70% and 30% available. No tension. 7,200 into 1 by 6 into 30% will be output VAT, right? Have a look. Makes sense? Tell me. 1,200 will be what? Input VAT fully taken. Out of that 30% will be what? Or you could do net 70% or you could do 100% and deduct output VAT on fuel of private use. Are you okay with this? You must have not seen this question in a lot of books. This is only here in my book. I am telling you, such questions I make it in class only, right? Then have a look. Car 3 has been bought for 23,000 pounds exclusive of VAT and is used for business as well as personal use. But are you okay with is the bifurcation of business and private use given? No. VAT on repairs is 1,200, fully available. 23,000 also input VAT, tell me. Fully available, nahi, only 50% available because it is business as well as private use, correct? And VAT on running expenses 1,500, correct? Input VAT on car 3, right? Calculate input VAT on car 3. Reimbursement received on VAT running expenses is paid, correct? Did I give fuel scale charge there? Tell me. I don't think I have given. Done scale charge of 3,500, right? So on car 3, how it will happen? Have a look. Car 3 input VAT 2,300, correct? Input VAT on repairs 1,200, right? Input VAT 1,500. You repaired full 1,500. First example is what? Full 1,500 given. Then 600 given. You will reverse 600. And if car 3 is there, correct? Then input VAT on purchase 2,300. Input VAT on repairs 1,200. 1,500 may say 3,500 into 1 by 6. 583 will be reversed. See, I am telling you, this you will not get in any book. My guarantee. No book has this question, right? Nowhere will you find it, correct? Can I go ahead? Tell me. Are you okay with 100% private use car will not be capitalized in books and no input VAT is available in business? Then impairment losses. If 6 months have passed from date of payment being due plus debt is written off from books of accounts, correct? You can claim the amount of VAT on irrecoverable debt as input VAT and reverse it accordingly. Have a look. You can claim the what? Amount of VAT on irrecoverable debt as input VAT and reverse it accordingly. So 6 months from the date of year, one only problem is there. 6 months have passed from the date of payment being due, not from the date of sale, but payment being due, correct? So let's say you do a sale on 1st January and 60 days is the period of what? Or 30-day period is the credit period. So your due date is 31st January, correct? Remember that. From 31st January, 6 months should pass, correct? Then you have a questions on how output and input VAT are calculated that you can do, no tension. Then VAT returns have to be filed on what? What is the due date of filing VAT returns, correct? 30/06/2023. That means 1 month and 7 days from the end of the quarter, whatever is the end of your quarter. So let's say your quarter end on 30/06/2023. 1 month and 7 days. 7/08/23. All records and returns are to be done digitally, correct? And VAT records are to be maintained up to 6 years, correct? All the VAT invoice copies, output VAT, input VAT copies that are there. Then you have two types of what? Tell me. Or a VAT invoice that is shared should have what? To be issued within 30 days of supplier sale and to be issued for all suppliers, right? Excluding exempt supplier do not require a VAT invoice, correct? Zero rated supplier do not require VAT invoice, or non-VAT registered customer, right? If you're doing, no VAT invoice is required. VAT invoice should be electronically prepared, right? Then types of VAT invoice. If supply is less than 250 pounds, right? A simplified VAT invoice will work. If more than 250 pounds, detailed VAT invoice. Simplified is what? Only you require very basic details, right? Like name of the party, VAT number, amount and VAT amount. Then amount of bill, invoice amount and VAT amount, correct? But if it is a detailed invoice, you have to write everything. Your name, customer's name, addresses, correct? Both the VAT numbers, correct? All the quantity that is sold, amount of quantity, rate per piece and all that stuff is to be written, correct? Errors on VAT return. If there is an error on VAT return identified by trader himself, it is not above the de minimis limit, right? Then he will have a basic standard penalty. If it is above what? Tell me. De minimis limit, then there will be a standard penalty plus what? Interest from due date to actual late paid VAT. And errors on VAT return is identified by HMRC. Standard penalty plus default interest, both will be there. Then de minimis limit is okay. Now, right? I hope you remember there is a point system. There is a point system, right? Where if you pay your VAT return late or file your VAT return late or pay your VAT late, correct? One default point will be added to your PT, correct or not? Have a look, right? So de minimis limit is what? 10,000 or 1% of taxable turnover, correct? What is de minimis? So if your error goes above the de minimis limit, correct? Then what will happen? Tell me. There will be standard penalty that is there, right? See, if you underpay tax or pay lesser VAT, correct? Or if you file the return late, in that all the cases, one penalty point will be added. Up to 4 penalty point, right? No tension. But fourth penalty point, say you will have what? Tell me. Problems, correct? But at every what? Tell me. Error, right? You will have a standard penalty. Somewhere around 200 pound standard penalty is there. Interest is 6.25%, 6.5% from date of what? Payment up to date of payment due up to actual payment date, right? De minimis limit is what? 10,000 or 1% of taxable turnover. Zero rated 20%, subject to upper limit of 50,000. Greater out of the two is de minimis limit, correct? De minimis limit means what? See, if it is below de minimis limit, no, standard penalty won't apply, correct? If it is less than de minimis limit, standard penalty won't. Above de minimis limit, standard penalty will apply. Company has 1250 of output VAT and under reported 7,500, correct? So how much and of input VAT over reported? It could be either you claim more input VAT or you claim lesser output VAT, so that you have to pay lesser amount, correct? So it's a de minimis limit where you can take up. Then 6.5% per annum. Okay. Default interest points also are there. You can do the points one from ACCA study up. You can do the point. Then VAT cash accounting scheme. Have a look. Eligibility criteria. What is the eligibility criteria for the VAT cash accounting scheme? Trader must be up to date with. So if you want to go to cash accounting scheme means what? In that you don't have to what? Do the as per invoice date, you don't have to take the tax point. The tax point will be what? When the cash is received against the what? Sale or purchase. Against the sale when cash is received and on the purchase when the tax is paid or when the cash is paid. So what happens? Trader must be up to date with VAT returns in last 12 months and have not committed any VAT offense in last 12 months. Taxable supply must be what? Less than 1.85 million. 1.35 or 1.85, right? 1.85 million, correct? Correct. And then what all included in taxable supply? 20% supply, 5% supply, zero rated, and sale of capital asset will not be included. But एक मिनट, ये 1.35 होना चाहिए is what I've understood. 1.35 million pounds, correct? Then, but if turnover goes above 1.60 pounds, from 1.35 you can stay in the scheme up to what? 1.6, right? Have a look. if this goes about, so cash accounting scheme, if it goes above 1.6 million pounds turnover, right? Turnover is nothing but 25 and 0 rated goods included. Cash accounting scheme mein what is there? VAT will be recorded output and input VAT on receipt and payment basis. No problem of bad debt. If the person does not pay your dues, then no need to take VAT ka what? Tell me. Input, correct? Not included in the scheme if payment is made more than 6 months after the issue of invoice and when the invoice is issued prior to services provided. Those people cannot be there into the what? Cash accounting scheme. I've given one example here, right? 1.35 million. Then coming to the annual accounting scheme. Annual accounting scheme is very simple, right? You have to file only one return instead of what? Doing how much? 4 returns. You have to do only one return. Annual accounting scheme, only one return for the full year, correct? Standard rated plus reduced rated plus 0 rated, all goods will be added here in the taxable turnover. Taxable turnover has to be less than 1.35 million and you should not have to do any VAT offense in the last 12 months, right? Leave the scheme, right? If in the last 12 months the expected turnover, right? So what are the due dates of payment, right? Annual accounting, return. First is due date is 2 months after end of annual period, correct? Return you have to file 2 months after the end of the annual, but payment, correct? VAT payment from end of 4th month to end of 12th month, correct? 10% of last year's VAT liability. So 4th to 12th, so 4th, 5th, 6th, 7th, 8th, 9th, 10th, 8th, 10th, 11th, 12th. And the last payment, right? Whatever is the last remaining will be paid on the due date of filing return, correct? And 10% of last. So first 9 payments you will make 10% of last year and then last payment, 10th payment you will make of what? The remaining amount, correct? I have taken a question of this, you can have a look. Has been asked a lot of times in exam, can be asked in your exam as well. Now what is a flat rate scheme? Now see, you take output, you take output VAT from someone, you pay the input VAT to someone, net all that you do, correct? Instead of that, don't take any input, only charge a reduced rate of what? VAT on your sales. Now whenever I say total sales is nothing but annual sales plus VAT, right? So annual sales is what? Standard rate is a reduced rate sale plus exempt supply plus 0 rated supply. Exempt supply is also to be added plus whatever VAT you add on it, correct? That is also to be added in total sales. So whenever you are doing a flat rate scheme, correct? First eligibility of the scheme dekh lo, have a look. Flat rate scheme, what is the eligibility? Eligibility is what? Your expected taxable turnover, right? For next 12 months is less than 150,000. Taxable turnover is a different term. Annual sales plus VAT is a different term. Okay, that is total sales is different term. So have a look in the question. What is taxable supply? Taxable supply is what? Have a look. Standard rated sales plus 0 rated sales. Those are standard. What? Tell me. Or those are taxable supply. So taxable turnover is how much? 75,000 plus 35,000, right? But VAT amount will be deducted. So plus 35,000. So 97,500. So below 150,000. So are you eligible for flat rate scheme? Yes. But your flat rate scheme mein, what is the amount on which flat rate? So flat rate will be a reduced rate given by HMRC. 12% is the rate given here in the question. Have a look. So this will apply on the amount of what? This 75,000 VAT amount included plus 0 rated 35 plus exempt supplies, all will be added. So 75,000 plus 35 plus 25 into 12%. No input or any other thing available. No offense to be done in last 12 months. Right? This is your VAT cash accounting scheme. With this, I think VAT, normal VAT, and also what? Tell me. Your VAT admin part is done. Do you want a break? Quickly take a 15 minutes break. Tell me. I hope you understood, or was it too fast? Tell me. Bolo, bolo. Anything that you feel you want to ask, tell me.
Understood, sir.
Understood. It was a bit fast, but IHT VAT, I'm telling you, don't even leave a single speck of what? Tell me. Portion untouched. Honestly telling you, right? We have seen questions in section B. Sara ka Sara same questions are repeated because there are no new questions now to be asked, correct? Right? So can we continue back by 10:37. Quickly come back by 10:37. Okay. Stay in the meeting, mute yourself and go. Okay. Quickly join in, guys. Tell me. Are you all back? Tell me.
Yes, sir.
So tell me, IHT VAT 20 marks worth of portion. Don't ignore anything, even a single question in IST or VAT. Don't even what? Tell me, think about leaving IST or VAT even a single part, right? Why I'm saying that? 20% confirm questions, correct? At times, you must have seen even 25 marks come from IST and VAT. So if you are serious about passing, there's no chance that you will what? Eliminate IST or VAT. Never ever leave IST or VAT at all, right? कुछ भी हो जाए, don't leave what? IST or VAT at all, right? So can I go ahead? Tell me. Now let's go into corporation tax, correct? IST VAT. Now corporation tax. Okay. आ जाए. Is the corporation tax notes visible to you? Tell me.
Yes, sir.
A company or a corporate can have an accounting period, correct? Now see, first thing that comes for corporates, correct? Two things are important in corporate taxation. One is the tax calculation, which has changed this quarter, but now 3 quarters have passed. So you should be very well versed with the tax calculation. Now tell me, any of you have been like or is going to give UK tax again? Tell me. Or is it the first time? Tell me. I think Tahir is giving again. है ना Tahir? Correct?
Yes, sir.
Anyone who's giving for the second time this quarter? Second time, anyone who did not pass last time around? Tell me. How many of you raise your hands? Yes, Tarjun is there, right? Keep in mind that tax calculation is very important. Okay, without this, you cannot pass the exam, right? So company or corporate can have an accounting period as per their needs, but taxation will happen as per the financial year concept. That means, let's say I have a period from 1st Jan 23 to 31st December 23, correct? In this case, I will have to divide that period in two parts because taxation of corporation happens on the financial year concept. That is 1/4/23 to 31/03/24. So first 3 months will be different. Next 9 months different rates will apply. And you will see that a lot of things are there and we have done a lot of calculations, right? Just like so now tax year concept is not applicable. So financial year concept is applicable to what? Corporation tax.
Sir, but you said na that the possibility of coming this kind of question is less.
The examiner is told, right, that those period, but have they given a lot of questions? Tell me, based on the same thing? Yes.
Yes.
So new rules are applicable from FY 2023. So whenever it is for the period 1/4/23 to 31st March 2024, right? But what will happen? Tell me. It is nothing but your FY concept that is there, right? So going ahead, calculation of tax of company, you have TATP after capital allowance of the company, interest income, property income, miscellaneous income, chargeable gains, gives you total profit minus QCDs gives you taxable total profits. Then UK residency of company is very simple. If the company is incorporated in UK, if yes, it is a UK resident. If no, then see whether it is incorporated outside UK. Yes. If that is the case, then whether centrally managed and controlled in UK. Yes. Then it is a UK resident company. If it is centrally managed, right, and controlled outside the UK, that is overseas, then it is a, so incorporated outside UK, managed outside UK, non-UK resident. Incorporated outside UK but managed in UK. When I say centrally managed, means major board meetings are carried out in which country? The what? Tell me. Citizenship or anything or residency of directors does not have any impact on the residency of the company. Now take tax rates. Two things are there, right? Now for a 12-month period, tax rate determination or tax amount calculation, correct? You have two different things, right? Tax rate determination happens with the calculation of what? Augmented profit, correct? If augmented profit is there, right? So whenever you have a taxable income, correct? Or TP or TTP. From TP, what do you deduct? Tell me. Have a look here. Where did it go? Here. From the total profits you deduct QCDs, you get taxable total profits. TTP, correct? TTP, right? So on TTP, tax rate determination or tax amount calculation, if augmented profit of company is less than 50,000, right? Then in that case 19% rate will apply, right? And on the TTP you will calculate what? 19%. But if the augmented profit is more than 250,000, then directly rate of 25% will apply, correct? And your income tax will be TTP into 25. Augmented profit is used to just calculate the rate of tax, but rate of tax applies on the TTP, correct? If TTP and augmented profit is the same, then no tension. But if they are different, then tax will be calculated or rate will be decided based on augmented profit, correct? It is a 12-month period, 50,000 or 250,000, correct? And rate will be decided by that, but the tax will be calculated TTP into 25%. But if augmented profit is between 50,000 to 250,000 for a 12-month year, correct? Then you do TTP into 25% minus the marginal relief, correct? This is how it is. So you have what? Upper limit minus the augmented profit, correct? Into 3 by 200 into TTP by AP is the marginal relief calculation, correct? That will give you a tax liability directly, right? That is how calculation happen. Augmented profit is nothing but TTP plus the dividend received from non-group companies, that is less than 51% holding company, correct? Then company has TTP of 175,000, correct? And dividend from, you can solve these questions, margin relief, how to calculate. There is only problem if accounting period of 12 months, correct? Straddling between FY22 and 23. That means, have a look at the question. 1/1/23 to 31st March, 31st December 2023 is the year. In that case, what should happen? First 3 months, directly flat 19%, because up to 20 FY22, that is up to 31st December 2023, the rate was what? 19%. Now it has changed to what? Tell me. 25 and 19, and marginal relief has come up. TTP for the period is 190. So what do? I divide 190 into two parts. First I will tax FY22, then FY23. FY22 directly taxed at 19%. FY23, how will it happen? First you will calculate augmented profit for full year, 215,000. Then you will accordingly decide what? Tell me. Your TTP or your tax rate. Tax rate is what? 25% minus marginal relief, right? At the end, in the marginal relief, how much ever months are included in your what? Tell me. In your what? Tell me. In your current accounting period, 9 months, that will be included. So whenever there is a 12-month period, correct? Augmented profit and everything will be 50,000 to 50,000. And when calculating marginal relief, if only 9 months are included in FY23, then only those 9 months. So if the in the whole period is within FY23, great. Upper limit, lower limit will be time apportioned. Dekho zara, will be time apportioned, and marginal relief, right, will be there, right? So less than 12 months. Wait. Then we have a table for this year. Straddling between, for marginal relief yearly basis into n by 12, correct? Then go to, if shorter accounting period, then your limits will be what? Upper limit and lower limit will be time apportion. Have a look. So company has accounting period of 1/10/23 to 31/3/24. The whole period is within 23/24 only. But there is a very low chance that this can come up in exam. So you can have a look. I have taken one example. Your upper limit and lower limit are what? Tell me. Basically, what? They are basically changed, correct? Have a look. So it comes to what? 250,000 into 6 by 12, 50,000 into 6. So it is 25,000 to 125. 92,000 is the what rate? So 85,000 into 25% and 92,000 you will do this, correct? And 457,000 or 457 is your marginal relief. This is something that you can do. Okay. Then I think CATP after
So,
this.
is there any chance of coming the short accounting period wala question in accounting straddling period?
No. Short accounting period can come up, but it has to be into 23/24 only, correct? In that case, what will happen? Upper limit, lower limit will go down, correct?
Yes.
But I had given you one more. Hmm. Accounting period straddling between 22 23 we have done. Short accounting period देखो less than 12 months. You are saying no? First thing is okay. If whole period is within FY23, right? ये जो दूसरा वाला है second part, right? If period is straddling between 22 and 23, upper limit and lower limit will be time apportioned by accounting period number of months, and at the end you will do what? Tell me. Upper limit into TTP into n by 12, correct? And marginal relief में you will do what? At the end, TTP and ATP will be for number of months falling. This you can, I think, ignore. I don't think this question has to be there in the exam. Ignore kar do, right? No need to go into detail because it plays with your brain. I know, right? Then let's go to what? Completely disallowed expenses. What are completely disallowed expenses? Correct? Completely disallowed expenses. Now we are going into what? TATP after capital allowance for companies, right? We will see how it goes. Now see, when whatever we have done in self-employment, the same thing will be repeated here. So completely disallowed expenses, appropriations, dividend paid to equity shareholder, correct? Will be a disallowed expense. Capital expenditure are always disallowed expense. See, company cannot have what? Salary to owner and all that. Company will have what? Dividend paid to equity shareholders because equity shareholders are owners, correct? So I have done what? From there only I have copy pasted the completely disallowed expense, purchase of capital asset, depreciation, amortization, but capital allowance will be allowed. Donation to political parties, right? Obviously, any subscription to political parties will be a disallowed expense. Then entertainment expense, entertainment of employees allowed, entertainment of customers, suppliers, anyone, not allowed. All amount paid by employer, that is company to its employees, will be allowed as a deduction for the company. What happens in the hands of employee has to look after it, right? Then shortlist premium, I think I don't even need to go into this. You're okay with shortlist premium? Tell me. Whatever revenue component will come here, correct? Revenue component by lease period into n by 12. Car leasing you have, correct? If CO2 emission is less than 50 grams, 100% expense allowed. If CO2 more than 50 grams, what will happen? Tell me. 85% of the expense allowed on leasing. Charitable also for company also the same thing is there. 4 conditions. What are the 4 conditions? Charity done to wholly and exclusively for business purpose, that is business promotion plus local charity plus reasonable in size plus it is a registered charity. If all 4 conditions are fulfilled, allowed as an expense. But there comes a twist. But if any one condition does not fulfill, then can you claim it as GGAD or QCD? In cases of company, it will be what? GGAD is not applicable, but QCDs are applicable, correct? Then gift given to customers, correct? Gift given to employees allowed as a reduction, but gift given to customers 3 conditions less than 50 pound per person per year, correct? Gift is not food, drink, tobacco or vouchers or conspicuous advertisement, that is visible advertisement. If all 3 conditions fulfilled, full amount allowed as an expense. Same method 1, 2, 3 logic also applies for companies, correct? Which we had done yesterday. If any one of the condition is not fulfilled, full amount of gift will be disallowed expenses. Gift made to supplier, family or anyone, disallowed expense. Impairment or provision of, yes, tell me that.
Sir, this 85 expenses of car leasing was same, the case was same with self-employment, na?
Yes.
So
80%.
there also 85% of expenses were allowed if car is more than 50 grams of emission.
Impairment of debt, correct. Impairment of provision as a percentage allowed, correct. Opening closing balance, I have taught this, correct. Opening balance is lesser or what, greater than the, or opening balance is lesser than the closing balance, then there is an increase in provision. Opening balance is greater than the closing balance, reduction in provision, that will be taxable income, correct. Then legal and professional fees, legal fees or professional fees for chasing debt, breach of contract, correct, allowable expense, correct. Breach of contract has been added for companies, right. Legal fees or professional fees for defending title of non-current asset, allowable expense. Legal professional fees for issue of loan note or raising long-term finance, allowable expense, correct. Cost of registering patents or trademarks, allowable. Accounting fees, allowable expense, correct. Then same thing with what, tell me. Legal fees with short lease, correct. Initial granting disallowed, renewal allowed, correct. Legal fees to long lease, initial granting disallowed, long lease what, tell me, or renewal also disallowed, correct. But issue of preferential equity share will always be disallowed expense, correct. Relief for pre-trading expense, same thing, 7 years and allowable expense, correct. Then associated companies, okay. Upper limit, all lower limit. Interest receipts, have a look for trade purpose and for non-trade purpose. For trade purpose, have a look. Interest receipts and interest payments for trade purpose, correct. For company as well as individual, what is the situation I have told you, because comparative analysis is easier. If it is an interest received or payment for trade purpose, any interest received can never be what, tell me, interest. Can you have a trade purpose interest receipt if your what main business ka, what, tell me.
No, sir.
Never ever, correct. Banks have what main purpose of borrowing, correct. You can never have interest receipt from trade purposes. Even if it comes up, you will not tax that income at all. Interest paid or payable on loan, obviously borrowed amount. Individual allowable expense, corporation allowable expense from TATP. But tell me, in corporations generally or individual also self-employment, it will be on accrual basis, correct. Then for non-trade purpose, if interest received or receivable, correct, on non-trade purposes, you give loan individually. If you give loan to staff and all that, correct, disallowed expense for individual. But for company, if non-trade loan given to staff, bank or anything of that sort, disallowed from TATP but allowed or taxable as interest income in TTP computation. Then interest payable on loan or borrowing, correct, for non-trade purpose. For individual, it will not be an allowable expense. But for corporate also, it is disallowable expense, but it will be allowable from interest income, correct. Then loan on commercially let out property, loan taken for acquiring property or loan taken to buy shares, all those things will be there. The same thing is here, correct. Then you can have a look at a very good question on this. I have done a very good question on this, how to take care of things, correct. Then capital allowances for corporations, correct. Capital allowances are what? Your all provisions of individuals apply to companies like AI, FY, small pool, WDA, main pool, SRP, short life asset, WDA calculations, all things apply. Cut, copy, paste, right? 12 months AI of 1 million, FY, 100% FY, small pool, WDA less than 1000. For what? Tell me. For a 12-month period. Main pool SRP provisions, right? Less than 25 years, more than 25 years, thermal insulation, all that stuff apply here also. Short life asset applies here. Less than 8 years can be identified or written as a different asset. WDA calculation at 18% for 12-month period, 6-month period. Private use adjustment cannot apply here, as company is not a physical person to use the asset, obviously, correct. Will it apply? Not at all. But when it comes to, now see here, you have to understand, they have given the provisions that when a 130% super deduction asset and a 50% FY asset, right? These are provisions which are not applicable in FY23, were applicable for two FYs, 21 and 22, right? That any, what, tell me, asset that you buy, correct? If it is a main pool asset, right? AI to chodo, you will get first 130% super deduction on main pool assets. Leave that AI aside. You will get 130% super deduction on main pool assets, correct? Available on new asset, correct? Right? But it was available against new asset and which are main pool assets, correct? 130%. AI not available on assets where 130% super deduction is claimed, because 130%. So if I do an addition of 500,000, you will get allowance of how much? 650,000. AI cannot be, or if there is a second hand asset, on that AI can be claimed. But if it is a new main pool asset, not 100% capital allowance, full 130% allowed, correct? WDA not applicable on 130% because there will be nothing left after deducting 130%, correct? So you do what? 500,000 addition, 500,000 deduct from here, from the pool, but in the capital allowance you will write how much? 650,000. But this is all old news, F1 22, FY 22 and 21 and 22, correct? Now this is not applicable, correct? This is not applicable at all. But sale of these assets, what will happen when sale of these assets happen is something that is applicable to you. Do you know all this 130%, 50% SRP asset? Tell me. Or no?
Yes, sir.
Or did you learn it? Tell me. 130% super deduction, 50% FY and SRP, right? So what will happen if it is a 130% super deduction? Simple, right? Then the whole sale value, right? That is higher of sale value or what? Tell me. Higher of sale value or OGC, whichever is lower, right, will be deducted or will be directly balancing charge. But if there is a 50% FY asset, right, of SRP, and if you have claimed 100% AI and FY claimed, then only the what proportion of that is claimed against the 50% FY will directly become balancing charge, right? All other things will be what? Tell me, deducted from the pool, right? And if there was only 50% FY on the asset, no AI, right? Only the 50% FY component will be what? Balancing charge. Remaining will be deducted from SRP. There is a question, very big question that I have done on this 3 years calculation. You can directly check from what? Even study of question is there, correct? You can check that as well. Now come to non-trade interest. Interest received on non-trade loan, correct? And interest paid on, I think we have done this, right? All income and expenses should be allowed on accrual basis only. So you have interest accrued. How to calculate interest payable? Interest paid plus closing balance minus the opening balance gives you interest payable. Interest received also, interest received plus closing minus opening will give you interest receivable. So we have to take interest receivable every time. Then debt written off for a company and recovered, correct? So if it is a trade debt written off will be allowable expense, right? Return of trade debt recovered will be taxable income. Not return of bad debt recovered, correct? Then in that case do nothing in TATP. But if there is a non-trade debt, right, it will be disallowed, correct, from the TATP will be what? But deducted from income tax, correct? Return of non-trade debt recovered, correct, it will be taxable interest income, not taxable in TATP. After that, this question is there regarding this. Property income for companies is very simple. Rent receivable minus allowable expenses minus rent not received only after tenant says so, correct? You cannot directly reverse the what? Rent receivable. Rent receivable will be for the full period it is occupied, not the actual rent received, correct? It will be on accrual basis. When there are multiple properties, you take the net amount of property income to the computation, right? Because it is TATP after capital allowance, interest income, property income, chargeable gain, miscellaneous income. No rental room relief allowed, correct? Short lease premium, full revenue component taxable. If you are a owner, company is a owner, full revenue component is taxable. Interest on loan taken for purchase and let out property will be deducted from interest income. No need to deduct from what? Allowable expense. Then relieving of losses for corporations. Now we go into losses of companies, correct? Now property income losses also, can it be used against the TP, right? Yes, relieving losses are what? You have up to total profit, then you have loss relief, you deduct loss relief from total profits. After that you do what? QCDs and you get TTP. On that TTP you calculate tax. Property losses cannot be carried back, property losses only can be carried forward. QCDs are what? Now see, if the TTP, right, or TP or TTP, whatever you want to say, TP before capital loss, right, is 10,000 and QCD is 5,000. 10,000 minus 5,000, 5,000 will be TTP. But if QCD is more than the TP before QCD or TTP before QCD, then your QCD cannot bring in losses. Now come to trading losses for corporate. Two situations where losses can arise. TATP before capital allowance minus the capital allowance, right, gives you TATP after capital allowance. Could be that TATP before capital allowance is positive, capital allowance is very high and hence you have losses. TATP before capital allowance is what? Tell me. Loss only plus capital allowance will reduce your losses, correct? Increase your losses, right? Ways in which here also individual have also had 3 ways. Here corporates also have 3 ways. Current year claim, carry back claim, carry forward claim. Correct? Current year claim means what? You can claim against TP. No partial claim allowed. So you will have to write off the full TP if you have to either carry back or carry forward the losses. Correct? Then carry back also you can carry back to previous 12 months. Correct? And no partial claim allowed. If full claim of TP, QCD will be wasted. Obviously, in both the case, QCD will be wasted. But when you carry forward, there is a positive thing. There are partial claims are allowed, so you can save the QCDs. Correct? So there are 3 ways in which losses can be relieved and 3 options. Now, what does the law say? That first option, what? Sir, you do it in current year, carry it forward. Correct? Option 2 is what? Don't use it in current year and then carry it forward. Then, sir, if I have to carry back the losses, see, you can carry back, but first you should complete current year claim. If anything remaining, or if you bring that TP to 0, then only you can carry back it to or carry it back to last year. Correct? And then if anything remaining, you can carry forward. Sir, can I first do carry back then current year? No. Law says that company has to first get their TP of current year to 0, and if any loss, they can carry back and then they can carry forward. Have a look. So all the 3 questions are here. Correct? Obviously, your QCDs will get wasted. Correct? And in current year and carry back, QCDs will get wasted. But when you go to carry forward, you have a option of what? Tell me. Carrying it forward, but only partial claims are allowed, right? This is the format for what? The thing that I talked about. Year and year, QCDs are wasted. Here you can save the QCD. Here you can save the QCD. Here QCDs are wasted. Correct? Then whenever you go back, now see the loss making, irrespective of the loss making period, when you carry back, you can carry back 12 months. Correct? And carry back 12 months on what? Tell me. LIFO basis or FIFO basis? Tell me. Have a look. When carry back losses 12 months, relieve losses on LIFO basis. So what you'll do from here, this is the loss making period, you carry back first this 6 months, correct, and this 6 months. From this 12 months, you take only 6 months worth of profit, take 6 months or whatever is loss remaining, whichever is lower, you will decide that. I have done a question here, correct? So loss making period may be 3 months, 4 months. Loss making period is not important. The carry back, if you have to do, first use it in current year, then when you carry back, you can carry it back 12 months, right? On LIFO basis. If before it is less than 12 months or even more than 12 months, you have to use only 12 months on the LIFO basis, right? Then terminal loss relief for companies. Company does not have a opening year loss because before that company was not existent only, correct? So no point of what? Tell me. Terminal loss or opening year loss relief, because before that company was not existent, so it will only be carried forward. But when it is terminal loss relief, that is last year there is a loss, correct? So have a look. Loss of last 12 months of business can be carried back 36 months, right? 36 months on what? Tell me. FIFO or LIFO? Tell me. Have a look. What basis?
LIFO basis.
LIFO basis, correct? So can be carried 36 months, huh? So here it can be what? 9 plus 6, 15 plus 12, 27 and 9 months from here, correct? So 36 months you can carry back, right? Then come to group implications, right? What are group implications all about? Tell me. A company, see, there are 2 types of groups. One is a loss relief group where trading losses, property losses and all other losses can be, or rather trading and property losses can be transferred from one company to another company. That is called as a 75% loss relief group, where you directly or indirectly should hold 75% in the company. That means A company holds 75% in B company holds 100% in C company, correct? In that case, A, B, C, A is holding 75% indirectly in C company, and hence A, B, C can form a loss relief group, right? Have a look. 100%, 75%, indirectly having 75%, correct? A company having 100% and 75%, right? But A company having 65% here, D company having in E company 100%. A, D and E cannot become a group, but A, B, C can become a group. Can D and E become another group? Yes, no tension. Then A holds 75% in B, B holds 75% in C, C holds 100% in D, D holds 75% in E. Here 3 groups can be made. AB can be one group, B, C, D can be one group, and D and E can be one group. Just a second. Have a look. So can these multiple groups, can B company be part of a group where B, C, D are there? Can B company be a part of what? Group of A company? Yes, why not? Allowed. Correct? Logically, there should be what? 75% or more ka group. Correct? Then can through a foreign company you have a what? Tell me group. Yes. A company holds 100% in B company. B company holds 100% in C company. A and C are UK company. Correct? Can you directly indirectly hold? Or can ABC become a group? Yes. But can you share losses with B company? No. No one can give losses to B company, or no one can have or send losses. B company cannot send losses to any of the companies, because it's a overseas or foreign company, right? Then a person who surrenders the losses is called as the surrendering company, and the person who receives the losses is called a claimant company. Correct? Surrendering and claimant, right? Never ever can a claimant pay any amount for receiving losses to the surrendering company, right? Correct consideration. Correct? You gave us losses, we are happy, we give you money. The only part that is important is when surrendering losses from one company to another company, the period should be corresponding period, right? So if let's say you have a 12-month period ending 31st December for A company, and for B company it is 30/06/24 as your ending, correct? You have to find the coinciding period, a corresponding period, and the loss and the profit, the loss of one company and the profit of another company, whichever is lower is transferred from the surrendering company to the claimant company. Correct? Losses that can be surrendered, you have a proper format for that. First preference given to what? Tell me. Your trading loss brought forward. Second, property business loss. Third is QCDs. Correct? So you add all the three together, right? If there is any interest income or miscellaneous income, right? All the losses you added, against that you use what? Interest income or property income. Correct? So whatever positive, negative will go outside, and current year trading losses will have the fourth preference that will be added to your losses. So total will be losses that can be surrendered. So you find losses that can be surrendered for the corresponding period. Then you find profit. Have a look. Profit that is eligible of claimant company against what? So in that, how do you do? These total profits minus their losses, correct? Losses, current year losses or brought forward losses, and QCDs you deduct whatever profit is eligible. A was what? Losses that can be relieved, correct? Or losses that can be surrendered. And for claimant company, profit that is allowable. Profit that is what? Allowable or eligible for claimant company. A or B, whichever is lower can be claimed. Correct? Correct. So you have to find A, you have to find B for the corresponding period and see whether what is lower that can be transferred. Right? Then you
Sir,
have a
all
7.
the unrelieved QCDs of the surrendering company will be added.
Yeah.
All the unrelieved QCDs of the surrendering company will be
Yes,
added.
obviously, yes. If you have losses, whatever is unrelieved QCDs will be. Have a look here. QCDs third preference.
So, sir,
Right?
that that QCDs should be of the current year only.
No. Generally they are current year only. Unrelieved QCDs will be of current year only. Correct?
Okay, sir.
Then going 75% chargeable gains group, correct? You are holding more than equal to 75% directly, correct? Or indirectly holding 50% or more, correct? And now there is a problem here. There, one company could be part of two groups, correct? Here that would not be allowed. Subsidiary of a subsidiary, subsidiary or subsidiary. Have a look. A holds 75% in B company. Now see, directly 75% and indirectly 50%. So A can do what? 75% in B company, great, right? B company 75% in C company, correct? So 56.25 will be what? Tell me. The indirectly holding of A company in C company. A, B, C directly holding 75%, indirectly more than 50%, allowed to be part of one what? Tell me group. Now C company holds 75% in D company, right? Can C and D company, now see, A company cannot be because A company has indirectly 42% here. So can it be a group? Can D company be part of ABCD group, chargeable gains group? No, right? But can C and D make a group? No, because what is saying C and D cannot form a CG group because as C is a sub-subsidiary of A company and part of a CG group with A and B. So it cannot become again a holding company for another company, right? Like this, correct? Cannot become holding company. This is not allowed. Correct? Have a look.
But for calculating losses, we can take it as a
हाँ, normal capital gains, normal loss relief group you can do, but CG group में D and D will not be allowed here, or C and D cannot make a chargeable gains group. But can they make a loss relief group? Why not? Right?
Yes.
Have a look. So A, D and C, correct? That also is there CG group. So A holds 65% in B, directly 75% or more, correct? Have a look. This can be done. Whenever you are what? A company and B company, correct? Are 75% CG group members, CG assets, no CG to be taken, correct? So between them, if A company sells anything to B company, no chargeable gains will arise, correct? And if there are any losses or even if there are any CG gains, they can be transferred to each other. One thing I think in the VAT we forgot was group implication of VAT, right? If you have a group, correct, and all VAT companies are, or all VAT companies are there, right? Or all group companies, generally there is 51% or more group, correct? Then you can elect one person or one company, not person, but one company to file all the returns of all the companies that are there in the VAT group, correct? VAT group implications are such, right? That is what VAT group implications are. And there is on sale and purchase between two group companies, there is no VAT, right? Internally, no VAT. And also, one return only filed of all the group companies, and it is what? All 8 group companies ka input VAT together, output VAT together. No need to do individual taxation, right? So one representative company will file all the returns, right? And input VAT and output VAT will be cumulative of all the companies, correct? And no sale or purchase or no VAT on sale or purchase of assets, correct? Now what we do? We do CG of companies at the end, right? Chargeable gains of individuals, correct? So let's say first thing of individual is what? See, 3 transactions. One is A selling any asset to B, correct? The selling price, correct, becomes what? The selling price or the disposal proceeds minus how much that person has bought the asset for will give you CG, correct? So have a look, selling price minus purchase price. Now other than this, correct, a lot of assets are there. There are also exempt assets. Exempt assets may you have major exempt asset is motor car, correct? Your QCB's qualifying corporate bonds are also exempt, correct? You have NSIC certificates that are exempt, correct? If you sell them, correct? If any ISA asset, no CG will, or ISA, right? Individual savings account, that will be also exempt. Car, remember, if it is a normal car, vintage car, motor car, anything, no CG arises on those. But now majorly assets are what? Tell me. Painting, jewelry, right? Antique furniture are all these, or maybe your main residence, correct? Those are 3-4 main assets that are there in chargeable gains, correct? Now see, it may happen that Mr. A and Mrs. A, both are husband wife, they transfer any assets between each of them as a gift, correct? No CG will arise on that, correct? But Mr. A and Mr. B, they both are unrelated parties. That means not husband wife, other than husband wife. If they send or if they give goods, right, to one another, right, for free, that is gift of asset, then selling price will be nothing but market value of property when the goods is gifted. Have a look. Value of transaction in CG, gift. Have a look, gift, correct? So Mr. A said, "Arey boss, I did not take any sale or sale consideration. I gave that person everything for free," right? So Mr. A, but what is it? Market value as on date of sale will be your sale proceeds minus the purchase price, giving you CG of 40,000. For him, the cost of acquisition will be how much? 50,000. That is the market value of gift as on date of purchase. Correct. So selling price will be 70,000. He has a cost of acquisition of 50,000. Even if he received the gift at free, CG will be 20,000. Correct. Then exception to the above rule, if Mr. A is husband, he gives any gift to the wife, there will be no CG, right? And the cost of acquisition of husband will only become cost of acquisition for wife. Have a look, right? That is how things work out. Format of calculation of CG: gross sale proceeds or gross disposal proceeds minus the selling cost, right? Very important to know what is GSP or GDP, because gross sale proceeds are going to be used going ahead, correct? Net disposal proceeds, right? Then minus cost of acquisition, you have what? Minus cost of acquisition. COI is what? Index cost of acquisition, and cost of improvement of asset. Both will be added to the cost of acquisition. That will be total cost of acquisition. From the net disposal proceeds, you will deduct this cost of acquisition and get the chargeable gains or capital loss that are there, right? Do it for every individual asset and get the net chargeable gains or losses, correct? So 4-5 assets if you sold during the year, it also follows a tax year concept. Whenever the asset is sold, that date will be considered for CG calculation for that specific tax year, correct? Now what will happen, tell me? Once you get all assets ka CG, from that you have AE minus of 6,000, correct? AE minus of 6,000 gives you taxable CG before what? Capital losses. Then from that, capital losses will be deducted and taxable CG will be there, correct? Taxable CG on that tax will be calculated, correct? Have a look. Now here 2 or 3 things. AE is restricted to what? Net CG. If 4,000 is the net CG, correct? AE cannot be 6,000 and loss cannot be great. AE will be restricted to net CG or max amount of 6,000. Have a look. 11,000 is the CG1, 6,000 is net CG, 6,000 fully deducted, 12,500, right? If it is less, then CG will be restricted to less than 6,000. CG cannot bring losses, correct? Trading losses, this you can have a look. Trading losses can also be used against CG, correct? This you can have a look once. What is this all about? Tell me. So you can use what? Let's say you have a CG minus capital loss amount can be compared with the loss. Now see, your normal trading losses, right, can also be used against CG, but after utilizing against what? Total income. So you utilize your trading losses against total income, and then you can utilize it against chargeable gain as well. But how much chargeable gain is what? Suitable or applicable to be relieved against trading losses? That is nothing but your net CG minus the capital losses. Amount of CG eligible for trading losses. Then you bring in how much is the trading loss that is available from the loss memo. You have around 47,000 or 11,000, whichever is lower is the loss that you can utilize, correct? So here if you would have seen, I have taken 11,000 only as the loss. Have a look here. Net CG minus 11,000. Then you have AEA. Then you have capital losses 0. You can go ahead. You can check once. I have made a small table for it, right? Then going ahead.
First we will deduct current year capital loss,
Yes,
then trading.
current year capital loss, whatever is remaining, that much only is eligible, correct? This is working note. This and this is eligibility. 47,000 or 11,000, whichever is lower. So I take 11,000. So from 15,000 net CG, I deduct 11,000. 4,000 is remaining. Then I deduct AEA. No capital loss is available, right? That is how it is, correct? Then Mr. A, I have given one question as well. You can try this. So here what will happen? 50,000 and 20,000. 30,000 is the net CG. Capital losses is 6,000. So 30,000 minus 6,000. 24,000 is the profit eligible to be deducted, correct? And you have losses of 20,000. So you will take losses of 20,000 to be deducted, correct? And you will go ahead and solve the question. Have a look here. Have a look. Loss memo. You have somewhere around 50,000. Okay. 15 or 24, whichever is lower. You take 15,000 deductible, correct? You can try this today. Then tax calculation. Now see, net CG minus 6,000 or minus whatever trading losses, minus 6,000 minus capital losses. If there is any taxable CG that comes up, right, you have to ask yourself, first you have to follow a columnar approach. What you have to follow? Columnar approach. What is the columnar approach all about? Tell me. In columnar approach, you will make what? Sir, if it is a normal asset and if it is a residential asset, correct? Or if it is a residential property. Normal asset, no tension, correct? If it is a net CG of normal asset or if it is a net CG of residential property. Normal asset will be taxed at. Now what will happen? You go with this taxable CG, go into the main computation. That is why individuals are taken first, right? Go into the main computation, right? Employment, self-employment, and what NSI, SI, DI. There you take the total taxable income from there. Over and above this total and taxable income, tax this CG, correct? Taxable CG, right? If this falls taxable CG is falling within which band, correct, is important. If this is 20,000 and your taxable CG is 20,000, right, then 40,000 is your now total amount. But this is already taxed. This second 20,000, how much falls within basic rate band? If any taxable CG falls within the basic rate band, which was unutilized here, utilized by this, correct, will have a 10% rate. And if it is in higher or additional rate band, it will have 20% rate if it is normal asset. But if it is residential property, this is normal total taxable income. You add this taxable CG, correct? This is already taxed. Here on this, whatever falls within the basic rate band, 18%, right? And whatever falls in the higher or additional rate band, 28%. This is how it will be taxed, right? Have a look. So your taxable amount is 20, 50, 160, 10, 10, 10,000 taxable CG if it is there. Here it will be normal asset 10%, 20%, 20%. If it is residential property, 18, 28, 28, correct? Then taxable income, when there is both the things, correct? Let's say, if you have normal CG as well and residential property as well, what you should tax first? Tell me. Should you tax? Now see, you have what? Total taxable income, normal CG, and also you have residential. So should you tax normal CG first, then residential CG, or residential CG first and then what? Normal CG. What you should do? Tell me. Over and above the taxable, total taxable income normally, you should tax normal CG first, then residential property or normal CG. Tell me.
Residential property first.
Residential property first or normal CG first. कुछ भी करो.
Any of them can work because the tax liability will be same
You
eventually.
can tax normal CG or residential property in any order. The tax liability of CG will be same. But now let's go behind, correct? थोड़ा सा let's go behind, correct? Net CG में you have residential property and what? Normal CG. You have AE and losses. You should use AE and losses against residential CG or against normal.
Residential CG.
Always preference will be given to what? Residential CG, right? You are saying correct, but while taxing the taxable CG, right, it should be what? Tell me. First, whatever you tax, it will not make a difference, right? Then, if there is a part disposal, correct? Part disposal of land, right? What will happen? You bought a 40-acre land. Out of this 20 acre you are selling. So ask yourself, right? 20 acre you sold for 20,000, correct? 40 acre you bought for 5,000. How much of this 5,000 are you going to take against the 20 hectare or 20 acre sale, correct? So the loss is cost of acquisition is nothing but initial cost of acquisition into sale of, or whatever is the sale amount divided by sale amount plus remaining market value of the property. Have a look. I have a question here. Part disposal. Net sale proceeds of part asset, correct? Cost of acquisition is cost of acquisition of total land or full asset into NSP, that is net selling price of part asset divided by NSP plus market value of remaining asset. This you can have a look. I have taken one question which covers everything, right? Then comes what? Tell me. Asset lost or destroyed. If asset lost or destroyed, there is a chance that you would have not insured the asset, right? If you have not insured the asset or if you have insured the asset, there are two options, correct? If you have not insured the asset and you have lost the asset, destroyed, gone, painting burned down, correct? Then you bought it for 5,000. You receive zero, nothing, because no insurance received. So selling price will be zero. cost to acquisition will be whatever is the cost to acquisition, correct? And you will have a capital loss. But you lost that painting, but received insurance proceeds against it, correct? If after you receive insurance proceeds, two options. You could use the insurance proceeds, not buy the asset, forget the asset, correct? Second, you could buy a reinvestment or you could buy a new asset, correct? So first, let me discuss what the insurance proceeds received. You forgot about the asset, correct? So insurance proceeds received. You lost the asset, so asset is gone, and you received insurance proceeds. That will become your net sale proceeds, correct? Minus the cost of acquisition will give you a capital gain. Generally, insurance proceeds will be higher. If not, then there will be capital loss. But if insurance proceeds received and you reinvest the amount within 12 months from the asset destroyed, correct? If you do full reinvestment, correct, no tension. Original asset pay, no gain, no loss, correct? But on the replaced asset, there will be a revised base cost. New cost to acquisition minus the CG, that is exempt, correct? But it has to be what? Your insurance proceeds has to be fully reinvested in what? New cost to acquisition, correct? Have a look. This is more understood by what? Tell me question. Have a look. You got IP of 15,000 on a asset destroyed, correct? And you reinvested full 15,000. 18,000 investment. Additional only you reinvested. In that case, CG would have arised 5,000, but no CG or CG implication will apply. This CG is nothing but deferred ahead and deducted from this new cost to acquisition, and revised base cost you will get 13,000. This 13,000 will be the revised base cost whenever this asset is sold, right? It will have a CG of 12,000. So nothing but 5,000 would have been tax here, but you deferred it to payment of or deferred it to sale of replacement asset. Then if you are not fully tell me, investing in the replacement asset, right? In that case, whatever is the difference or whatever you have not tell me, reinvested will be your CG. So what will happen? 15,000, 12,000 is reinvested. 3,000 will be from the 5,000, 3,000 will be taxable CG. This 2,000 will be what? No gain, no loss treatment, and will be deducted from the new cost to acquisition, and you will get a revised base cost. Have a look. Make sense? Then if there is asset damage, have a look. Okay with this?
Yes, sir.
Yes. Then asset damage, no IP received, correct? Asset damage means what? Is it destroyed and lost completely? No. It is only damaged. There were 4 legs to a table, 1 leg gone, correct? No IP received, correct? Do nothing as asset is still in possession. IP received on damage. Now see, out of the 4 legs of a table, 1 leg is lost, correct? You receive IP, you do nothing. Sir, let the table be 3-legged table only. I don't want to do anything, correct? In that case, IP received is nothing but what? Net sale proceeds. You did nothing and you lost 1 leg, correct? So you will do cost to acquisition into IP received. As you do what? Part disposal. IP received by IP received plus market value of remaining 3 legs of the table, or table with only 3 legs. You will get a cost to acquisition, that will be CG. But if you get the IP and use it in restoration work, correct? Then what you have done? Now tell me. The basic cost of acquisition will change. Basic cost of acquisition, you received some IP, correct? That should reduce the cost of acquisition, but you did restoration, correct? That would increase what? Again, the cost of acquisition. So have a look. There is a question here. Third part. Mr. A owns the antique furniture which is damaged in flood recently. Mr. A bought the furniture for 1,500. If IP received for damages is 7,000 and restoration is 8,000. Now have a look how the C part is solved. So your IP received 7,000 fully used for restoration work. So IP received 7,000 will be deducted. 8,000 is the expense that you made. And new cost of acquisition of the machine will be how much? Or of the painting will be how much? 1,000 extra you spent. So 15,000 then damage you made, correct? By additional 1,000 cost. 16,000 is the new revised base cost. When this asset is sold, 16,000 will be the cost of acquisition. Right? Then asset. There are 4 types of asset: intangible, tangible, movable, immovable, correct? Intangible, tangible, movable, immovable. If there is an intangible asset, that is trademark, copyright, everything, correct? We'll see how the asset or how the working of this happens, correct? Generally, they are wasting asset less than 50 years life. Then there is a tangible or immovable asset, land and building, normal CG calculation will happen on that. So intangible, tangible, right? Or intangible, immovable. But if there is a tangible and movable asset, right, it is called as a chattel, right? Example, boat. Boat is tangible, movable, right? Plant and machinery, tangible, movable. But in that also, then if I say horse, horse is also a what? Tell me. Asset only. Is it tangible and movable? Yes. Right. Then in that you have two options: wasting chattel and non-wasting chattel. Non-wasting chattel has life of more than 50 years. Wasting chattel which have a life of less than 50 years, correct? Which are living things, correct? Other dog, cat, horse, boat, etc. Right? Living things and certain assets, correct, is completely exempt. But when it comes to fixed plant and machinery, it is taxable. Non-wasting asset may you have what? Tell me. Painting, correct? Can painting go more than 50 years? Yes. Right? Your painting हो गया, then antique furniture, correct? Right? Jewelry, all these are what? Non-wasting chattels, right? So have a look. This is the normal depreciation, and may what you do over and above the original cost, whenever the selling price is, you get a CG. But there will be no capital loss, because capital loss on fixed plant and machinery will be recorded in the books. Have a look. They are adjusted in the capital loss, correct? Now come to non-vesting chattels. Non-vesting chattels may what you have to do. First thing you have to see whether the gross sale proceeds is less than 6,000 or more than 6,000. If the gross sale proceeds is less than 6,000, great, correct? Because less than 6,000 means what? Tell me. Now, I have seen n number of times students being confused here. 100% times. Painting, jewelry, antique furniture. Wherever gross sale proceeds are less than 6,000, you will always have a problem. Correct? Now see, if gross sale proceeds and cost of acquisition both are less than 6,000, CG is exempt. But if gross sale proceeds is less than 6,000 and cost of acquisition is 10,000, in that case, will you have losses? Tell me. Yes, you have capital loss. You cannot do anything. Correct? But your GSP will not be less than. So GSP is deemed to be 6,000, cannot be less than 6,000, and loss will be reduced. So say 4,000 is your gross sale proceeds. You sold the asset for 4,000. You bought it for 10,000. Correct? Normal loss would be 6,000, but law says no. This 4,000 should be made 6,000. So loss is only 4,000. Here I have a question. Everything has a question here. Correct? 5,000, 1,000 may you bought it, 5,000 may you sold it. Both less than 6,000. Correct? No tension. Right? Then if Mr. A has purchased a painting for 9,000 and sold the same, right, for 5,000. Correct? So 5,000 will not be considered as the GSP. So deemed GSP will be how much? 6,000. Right? No questions asked. 6,000 GSP. Then if gross sale proceeds are greater than 6,000, correct, and cost of acquisition is less than 6,000, means what? Your higher capital gain will be there. But what does the law say? Do the normal cost or normal CG calculation. Also do another calculation. 5/3 into GSP minus 6,000. Correct? Whichever is lower will be taxed as CG. Then if GSP more than 6,000, cost to acquisition more than 6,000, fully normal CG taxation will happen. Have a look at this question. This one. Mr. A sold an antique furniture for 17,000, correct? And paid 200 pound as selling cost. Cost to acquisition is how much? 4,600. Is the cost to acquisition less than 6,000? Yes. Do normal calculation. 17,000 my selling cost of 200 will be deducted. So 16,800 is the NSP minus cost to acquisition 4,800 gives you 12,000 as CG. But when you go into this calculation 5/3, you have to take gross sale proceeds, that is 17,000. Don't take 16,800. So 17,000 minus 6,000, right? So it is saying what? GSP minus 6,000 into 5/3. So 18,333 or 12,000, whichever is lower. 12,000 will be there. Just remember, this 17,000 will come here, not this sale proceeds, correct? Keep that in mind, correct? Mr. A sold his antique furniture, okay. This also you can try, where this was lower, correct? That is there. Then copyright, intellectual property, similar intangible asset, wasting asset. Very simple. Mr. A purchased a copyright of book X for 20 years at 55,000. He used the copyright for 8 years. So what you'll do? And sold the remaining at 37,000. So 37,000 is the net disposal proceeds minus cost of acquisition. What you'll do? Sir, I used it for 8 years. So from the cost of acquisition, 8 years I will deduct. 12 years worth of cost of acquisition I can deduct. So how will I do? Cost of acquisition by total life of 20 years into how much is remaining life? 12 years. I will multiply that, correct? And this is my CG, correct? So NDP minus what? Cost of acquisition, original cost of acquisition into number of years for which intangible sold divided by total life of intangible asset, correct? With this, your normal losses and special, normal CG and special CG is over. Now we are going to CG for companies. After this, I'll give you a break, right? Basic CG for companies we can do, correct? And then when it comes to shares, correct? And reliefs, shares and reliefs will happen after break, correct? So have a look, CG for companies. Your chargeable gains from your computation, we will go here. Gross sale proceeds minus the selling what? Cost gives you net sale proceeds minus cost of acquisition, that is cost of purchase, correct? Right? That will give you cost of acquisition before indexation, that will give you CG before indexation, because for companies CG is allowed up to December 2017. After 2017, if you have bought any asset, no indexation will come. But if you have bought an asset before, have a look. Asset sold in FY23 but bought after December 2017, no indexation allowance. But asset sold in FY23, asset bought before December 2017, IA applies up to December 2017. So you calculate, how do you calculate? Sale proceeds minus cost of acquisition gives you CG before inflation minus indexation allowance. How do you calculate indexation allowance? The cost of acquisition year into the indexation factor. When you take indexation factor, take from purchase up to December 2017 only. You don't need to take up to December 2023, because now what? Cost of acquisition or indexation is only applicable up to December 2017. Have a look here. So Mr. A has bought an asset on Jan 2012, 35,000, sold on what? 74. 74 minus 35 is CG before indexation. Then go here. From Jan 2012 to Jan 24. Can you take indexation up to Jan 24? No. You have to take only up to December 2017. So you take this rate into the cost of acquisition that is there. This is your what? Indexation allowance. And your CG after indexation is how much? 26,365. But can indexation lead to losses? No. Company has an AEA provision, no provision of AEA or anything. Indexation allowance is restricted to CG before. So if this 39,000 was 10,000 CG before indexation, you would take indexation allowance only 10,000. Indexation allowance cannot bring losses. Have a look, right? Taxable CG. With this, I think company ka basic part is over, correct? WAD to be calculated on the same. Okay. After this, we can do share pool, right? We have another sheet for what? Wait. CG implication of share and for securities for companies. Wait. First, you can do individual ka share pool. I think it is available here. Correct. Chalo, we'll do it after break. Take a 10 minutes break, right? So come back by, let's say, 11:53 a.m. चलो आ जाओ, quickly come back. We'll complete this so that we are done with the revision, right? I don't know. I think all of you were there in class yesterday also. I've uploaded the lecture on YouTube as well for your views, correct? Can we go ahead? Tell me.
Yes, sir.
Yes, sir.
So now let's go to what? Just a Now tell me what is better at the end. एक minute. Securities. Now tell me, once we are done with CG, okay, would you rather want me to help you in how to write the paper? थोड़ा सा giving you insights about what? Tell me. Paper writing skills and time management, or would you want me to do tax admin at the end? Tell me. Or you want to do both things?
Paper writing skills.
Sure, beta. Let's see if I can complete within time, correct? I'll do what? Tell me. Tax admin also I'll complete, and paper pattern also I'll talk about it. Okay. Now just a second. Let me just figure out. We have to have what? We have to have what? Shares ka, no? Correct. PG. We have to have what? CG shares, no? And reliefs. ठीक. I've got it. Okay. Yeah, after paper writing tips, we will keep tax admin. Now see how will the preference go, correct? Now see what happens generally. Some problem. Wait, why am I not finding the note? I'll find them. Wait. Nine 11, 17 11, 26. That should mean then I have a lot of notes, no? Lifetime allowance. Charge. Yes, individual CG implication of shares, correct? If it is quoted shares or listed securities, correct? If sold abroad, normal valuation rules, but if gifted, then what you'll do? Higher price plus lower price by 2. You have exemptions, correct? 1 or 2, 3 exemptions on shares, correct? Qualifying corporate bonds are there, right? Those are not very ISA, that is that we've discussed this, correct? Then coming to unquoted shares, correct? Now see, quoted shares, if they are gifted, what is the value of the gift, correct? The selling price. Selling price will be the gift minus the cost of acquisition, right? Then come to normal sale of quoted shares and securities, correct? Now what happens now? See, here there is a sale, okay? 10/1/23. Unquoted shares and quoted shares. Now the problem, biggest problem is what? You have sold these 350 shares, correct? But now how will you tell me? Take care of this. This is the biggest problem. 350 shares sold for 12 pounds each, right? Now you have bought certain shares before it and bought certain shares on the same day and on the next days or 1 month within the sale, correct? So have a look. So these 350 shares, right? What should be the cost of acquisition? That is the problem. So cost of acquisition, they have said that the first preference should be of shares that are purchased on the same day. So this 350 shares sold, correct? So your selling price will be there, correct? 350, right? Minus cost of acquisition, first preference given to the same day purchase, second given to after 30 days or within 30 days after sale, whatever is the or whatever are the number of shares. So here in this case 150, so 150 done, and remaining 200 from the share pool, that is these 600 shares, correct, on a weighted average basis. So these 600 you bought for how much? Total of 500 plus 1200 plus 2400, 3600 plus 500, that is 4100, correct? And divide by the number of shares, 600, that will per share value, and out of this you have to take cost of acquisition of how much? Remaining 200 shares. So it will happen like this. This is the share pool, right? And 4100 by 600 shares into 200 shares will give you cost of acquisition of the 200 shares. This will be used against the selling price of 350 at 12 pounds, correct? This is how share pool logic work out for an individual. This is for an individual, correct? So have a look. First preference, shares acquired on the first date or in the same date. Shares acquired within next 30 days. And third preference is what? Share pool. All shares before date of sale should be added and a pool should be formed, correct? Then implication of what? If in the share pool, right, there are bonus shares, right, then no need to do anything, only number of shares will increase, correct? No, see, bonus shares are generally given free of cost. Right shares are nothing but a normal purchase. Add the number of shares and the right issue cost that is there, correct, in the cost that is there. But when there is merger or takeover of one by the other, what happens? Old shares are cancelled and either cash is given, new shares are given, or new equity plus preference shares are given. So in that, what is the question? In the share pool, how to distribute the cost of acquisition? Old cost of acquisition to the new shares given, because old company has been what? Closed and new company has started. So the loss is the cost of acquisition should be divided among the equity shareholders, right? Or in the equity share, preference share and cash in the ratio of market value of equity, preference and cash, correct? So only shares received in consideration or equity share plus preference plus cash received in consideration. Have a look. What is the format? CG implication of takeover or reorganization. Cancel old shares, correct? Cancel the old shares, right? Have a look. Cancel the old shares. Use the cost of acquisition of old. See, if old shares given, new shares received. Correct. What will happen? Old shares. Old shares what? Tell me. Cancel the old shares. Get the new shares. Same old cost of acquisition will be there. That means 100 shares you give and 200 shares you get. Correct. So it will be the old cost of acquisition for the new shares. Correct. But if in place of shares, equity share, you get equity share and preference share both. Then you take out what? Take old cost of acquisition, take new equity and preference ka market value, correct? Market value of both, right? And divide this old cost of acquisition in the ratio of market value. Have a look. Market value. Here it would have been done. I think questions are not there, right? Okay, you can make out. And then what if it is what? Tell me. Shares taken, and instead of shares they have given equity, cash, preference, all three. Cancel old share, distribute the old cost of acquisition in the ratio of market value of share and cash consideration, correct? Take care that shares are to be sold, right? Of what shares are to be sold. Now see, when you are selling, only generally equity shares are sold, right? This is for individual, how the things will happen. Now going to company. Company mein first let's discuss the preference for companies. Now see, in company how the calculation will happen, hear me out. You have your gross sale proceeds minus cost of acquisition before indexation. You will get CG before indexation and minus the indexation of shares, correct? So when you are deducting cost of acquisition, correct? Simply you will have first preference shares acquired on the first day, right? Second preference shares acquired within 9 days before disposal, and third would be all shares 9 days before the date of sale should be added in the what? Pool, and indexation should be applied as per operating event method. I hope everyone knows what is operating event method. Yes or no?
Yes, sir.
You know what is operating event method? Tell me. Everyone, what do you say, Sana? What all are operating events? Tell me. Normal
Sir,
sale or
purchase, sale of
Purchase.
shares.
yes. Bonus, is it an operating event? Tell me.
No.
No.
Right issue is a normal operating event because you purchase, correct? Takeover or reorganization, it is an operating event irrespective of the consideration received. So when takeover or registration, reorganization happens, right? You have to do extensive calculations, correct? An operating event will have an implication of indexation on transaction before December 2000. So if any purchase is done before 2000, what? Tell me. 17. In that, will it happen? Yes. Right? That is how things work out, correct? So do you want me to tell you this question how it works out? See, whenever there is an operating event, so first you have to have a columnar approach. Share pool mein columnar approach, correct? You will have purchase number of shares, correct? Cost, and you will do a calculation of indexation allowance. Cost will be different, indexation allowance will be different. At every operating event obviously has to be before December 2017. At every operating event, you take the cost of last purchase, correct? Add it into the what, or add indexation allowance on that up to the date of operating event. So let's say 2010 may you did a purchase and 2012 may you did a purchase. So before adding this purchase of 2012, your indexation from 2010 to 12, add it on your original cost of asset, correct? Then show cost 6000, whatever in indexation acquisition, let's say 6000 is the cost. Then add this cost into it, 6000 plus whatever new you have added, new cost. Then at next operating event, take this 6000 indexation allowance plus the second purchase, take all this up to next operating event, calculate indexation allowance on that, still keep cost different and indexation allowance difference, and total cost difference, your cost with indexation allowance. When deducting, first deduct only cost, right? And then deduct indexation. And doing all this indexation will only be applicable up to December 2017, correct?
Sir, is it better to do it event basis or we have to total it and then add
You
it?
have to do it on event basis. You have to keep cost, indexation allowance, and cost with indexation. 3 different columns you'll have to make in your what? Tell me.
What will be easy? Like I'm getting a bit confused there only.
Simple. I'll tell you. I know this is one of the most. Actually, this should not have been a part of your syllabus. Honestly, if you ask me, this should not have been part of your syllabus at all. I'll just show you one transaction, how it is to be. Simple.
Sir,
See,
what is the weightage of this portion in exam? Like, can we
there
skip
is
this?
nothing, no one has given any weightage for this at all, buddy. You have to do it. No option at all. Correct? There is no weightage. No one has said that it will come compulsorily for 5 marks, or no one has said it will not come compulsorily for 5 marks. Corporation tax itself has a weightage, correct? So उसमें
Okay.
what will be asked is something that only examiner and God knows, correct? You and me cannot predict.
But sir, at the least, at the very end moment, can we skip this if we want to?
See, if you want to, but I am taking, give me 2 minutes, I'll make it very clear. Have a look. Let's say you have company A shares. Okay. You bought it on 1/1/2010. I hope the screen is visible.
Yes, sir.
1/1/2010 for 5,000 pounds or 5,000 shares at 10 pounds. Just do the calculation. This is 50,000 pounds, correct? Right? This is the share pool, right? So I am converting this share pool, or wait, I'll first do the purchase, right? Then you have a purchase. This is a purchase, correct? Another purchase on 1/01/2012 of 2,000 shares at 12 pounds, correct? So it comes to almost 24,000 pounds, right?
Yes.
Now I will give you indexation factor from Jan 2010 to Jan 2012, right? Is, let's say, 0.167, correct? And I will give you Jan 2010 to December 2017, correct? 0.678, and Jan 2012 to December 2017. I know this is the biggest problem for all the students. 538, correct?
Yes.
Now, how to do this? How the share pool will work out? Have a look. Simple. I am making a share pool, or better, I'll make it on the next page. How will the share pool work out? Share pool mein I will make what? Let's say sale or purchase or sale one column, correct? I will do number of shares one column, cost, original cost one column, indexation allowance one column, and cost plus indexation allowance one column, right? Have a look. This will not be used generally in the sale and purchase that is there, but have a look. Now I purchased. First tell me how much did I purchased? 5,000 shares, correct? Cost was
Yes.
10 pounds, right? Or 5,000 per share also I'll put up. Per share here in between, 10 pounds, correct? So you have cost of 50,000 pounds. Here no indexation allowance as of now. Date also I'll put up Jan 2010. Then I have next operating event on Jan 2012. I will leave 2 lines in between, correct? Jan 2012, right? I will calculate what? Up to 2012, that is before the operating event, I will calculate how much is the indexation allowance. So how much is the indexation allowance? Tell me.
0.167.
5,000 into how much up to 2012, how much it is? 0.167. So how much is this?
8350.
8, how much?
8350.
8350, 50,000 into 0.167. So now cost plus IA is how much? 5,000 plus 58,350, correct?
Yes.
Now Jan 2012, there is a purchase, correct?
Yes.
Purchase of how much? 2,000 shares for 12 pounds, so 24,000 pounds, correct? So now have a look. Your cost is how much? Tell me. Up to date, up to Jan 2012, how much is your cost?
24,000.
24,000. Indexation allowance is 8350, and cost with indexation allowance is how much? 82, na? 82,350, correct?
Yes.
Let's go ahead. Now tell me, if there is no other operating event, you have to calculate indexation up to what date? Tell me.
December 2017.
17. So December 2017, I'll say up to December 2017, I have 82,350 cost plus indexation allowance. On this, additional indexation allowance will apply. So your Jan 2012 to December 2017 will apply on what? This 82,350. Here I will do 82,350, correct? Into how much is the factor? 12 to 17. Tell me.
0.538.
Correct. So how much is that? Tell me. How much?
44,304.
44,300,
304.
correct? And you have how much? The cost of acquisition is 74,000 only, or main basic cost is. So now tell me, if I have to ask you, as on December 2017, cost is how much? Total cost. 74,000, correct. The indexation allowance is 8350 plus the 44,304 you have calculated. So how much is that? Tell me. 52,
52,654.
54. And total cost of acquisition plus IA is how much? Tell me.
126,654.
126,654, correct. Now let's say from this, 1 minute. Let me just take this. From this, if you are selling 2,000 shares, or let's say 3,000 shares you are selling, right, at 15 pounds, correct. So what is the sale price? Tell me. 3,000 into 15, how much will that be? 45,000, correct. Now minus cost of acquisition I have to do. Cost of acquisition first I'll do before indexation. So what I'll do? Have a look. 74,000 is for how many shares? 7,000 shares. How much is for 3,000? Tell me how much is the cost of acquisition before indexation? Tell me. 74,000 by 7,000 into 3,000.
31,714.
31,714. So before indexation, CG before indexation is how much?
13,285.
Then I will say what? Total indexation for 7,000 shares is how much? 52,654 for 7,000 shares. How much for 3,000 shares? Indexation allowance. Tell me. It will be more than 13,000, I think.
22,566.
But it will be restricted to what? 13,000 to
32.
0 will be the CG. Are you getting what I'm trying to say?
Yes.
Sir, what did we do in the last indexation allowance? Can you explain that again?
How much is the indexation allowance? Calculate.
Total is 52,654.
But that is for a full, or that is for 3,000 only, or for full 7,000 shares? Tell me.
For the entire 7,000 shares.
How much for 3,000?
Okay.
Correct.
Last cost plus indexation allowance will be used where?
Sorry?
The last column total.
This is only used for calculation year.
Okay.
This 82,350 is used for calculation of what? Indexation allowance on the next date. Correct?
Got it. Got it. Thank you, sir.
Correct. What do you say, Tajun? Okay with it? Tell me. Or Mohammed, what do you say? Okay with it? Did you know this? Tell me. Then let's go ahead. Correct. Now in that operating events, takeover or reorganization, same thing, but see in takeover or reorganization, right? What will happen? Tell me. Operating event takeover or reorganization, that is a very complicated procedure, right? So takeover reorganization chhod do. If at this situation it is not done, it will make your life hell if you try to go through it once, right? Normal, this type of question can appear in exam. If it has to appear, it has to appear this kind of question only. Don't worry too much. Okay. Now, Ajo, this is done. Now, can we go into reliefs? Tell me. Reliefs for individual. The first thing is private residence relief, right? What is private residence relief? Whenever a main residence or what? Tell me. A main residence is sold, right? And if you have stayed full time in the main residence, correct? Then no tension at all. Full CG will be allowed as what? PRR, private residence relief, correct? Full CG will be allowed as what? Private residence relief. But if you don't stay full time in the property, in that case, private residence. So generally what happens, let's say you bought the property for 50,000, sell it for 150,000, correct? So 100,000 is your CG. If you have stayed full time in the property, then CG minus 100,000 full relief will be available. But if you have not stayed in the property full time, in that case, what will happen, correct? In that case, your private residence relief will be gain into total period of occupation deemed plus actual, the whole divided by total period of occupation, correct? Total period of actual and deemed occupation divided by total period of ownership, correct? Occupation divided by ownership, right? Now in that deemed, see actual to actual, whatever you are going to stay will be added. But when it comes to deemed mein there are three clauses. First clause is come what may, last 9 months will be actually occupied, and it will be deemed that last 9 months are actually occupied. Second, if you leave, right, for job abroad, correct or not? Leave for job abroad, correct? For employment abroad and come back. That situation is also considered to be what? Occupied. Now the problem a lot of students have, they have to leave from their property, correct? And come back to the property. Then only that out of what? Country, that is out of UK or abroad, what? Job will be considered as what? Deemed occupation. Because why? Because if you do not return to the property, that will not be deemed, right? You must have seen that also. Let's say if I leave the house, I go to some relative's house, then I go abroad, come back, go to some friend house, and then come to my house. Have I left the house? Yes. And have I come back to the house? Yes. That is how things work out in a PRR. You must have seen those questions. Individual goes to stay in some other city for employment purpose, up to 4 years allowed, and for any other reason up to 3 years allowed. Both situations may have to go and come back, correct? But if it is impossible in 2 and 3 to come back, in that case it will be deemed occupation for 4 years or whatever. So for out of India, what? Tell me. If it is there, right, then logically what will happen? Tell me. It will be allowed, correct? Fully deemed occupation. That is how it is. Then PRR plus business use, logically letting relief, wait.
Sir, so if someone goes out and stays at place of relatives and then comes back, so the entire period or entire duration will be allowed?
Yes,
So
I
it will
told
be
you,
termed as deemed occupation or actual occupation?
deemed occupation,
Okay.
right? Then there is PRR plus business use. What is PRR for business use? If for full period of ownership, part of the residence. Now see, 10 rooms I had, correct? 8 rooms from the first day I am using at was business personal use, and 2 rooms as business use. Then whatever CG I get, 2/10 part of the CG will be what? Taxed. 8/10 will be what? Allowed PRR, correct? Now what happens if you do what? Partly use it for business, partly use it for what? PRR. एक second. Have a look. I have this shares wala question here. Share pool of B Limited. All these I have done here. You can have a look here. I have given you these notes, correct? Operating event. Now have a look. CG relief individual. Mr. A and left for overseas work to USA in Jan 25 and returned back in Jan 2017. 2 years will be considered as what? Actual occupation, correct? Mr. A bought a house in Jan 24 and left for overseas work to USA, right? Stayed there up till sale, did not come back. If he did not come back, still last 9 months will be considered deemed occupation, correct? And his stay there, correct, will not be considered what? Deemed, because he did not return. But if it was impossible, you will consider. Now have a look. Lived in the house 14, that is actual occupation. Lived in a rental property in Southampton, right? It is for any other reason 36 months are allowed. Employed overseas, so from there only he went, right? Then he said what? Lived with relatives there, or came back, lived with relatives and came back to the house. So this 12 months will be deemed occupation because he left the house. Even if he has taken a route and then come back, correct, still it will be allowed. See whether you're okay. Okay. Then he lived 161. 115 he did not live in the house, correct? But tell me, last 9 months will be considered? Yes. That is how things work out, correct? I have taken 1 or 2 questions here. Then business use, have a use, 2 rooms. I have give you example, right? PRR plus business use, if part of the property. Now have a look. This question is very important. Mr. A bought the house, correct, on 105/20/2001. Up to 2009, he used the full property, correct, all 8 rooms, but converted 1 room after that, right? So how it will be? First 8 years that he occupied the property fully, will be actual occupation. But then coming to the second part, right, where he only occupied 7 rooms, right? So you have 167 months that is there before sale. 9 months will be deemed occupation, and remaining what? How much? Out of the 167, 158 will be remaining. Into 7 by 8 will be actual occupation, and remaining will be not occupied. Correct? Not occupied will be disallowed, and 243 upon 263 will be allowed. So your whatever amount into 243 by 263 will be allowed. And tell me, what will be the tax rate on these sale? Tell me, sale that you do of residential property, what will be the
20 and
tax rate?
28%.
18 and 28%.
18 and 28%.
Correct. Letting relief, only part of the property is let out for residential purpose, paying guest, and the tenant has no access to other rooms, right? In this case, what will happen? You will calculate CG. CG may say minus letting relief. Letting relief, 3 options, lower of the 3. PR relief, that is already available because you are going to have some PR relief or 40,000 or part of gain attributable to letting period. There is one question that I have done for it. Here also last 9 months will be deemed occupation, correct? You can have a look at this question. Very good question, correct? This question has appeared in exam before, can appear in exam this time. Then you have business asset disposal relief. What is BADR? Have a look, right? CG on sale, that will be taxed. So BADR is not a relief. That will reduce your CG. It will tax your CG at a lower rate. Even if you have normal asset in BADR, the 18% rate will not apply. 20% rate will not apply, only 10% rate will apply. There is a lifetime limit of 1 million on which you can use business asset disposal relief. For once, just hear me out that what? Tell me. Let's say that you have BADR. You don't know what is BADR qualification, correct? But you have BADR asset, correct? So whenever over and above that 1 million, if you have BADR, it will be taxed at higher rate, that is 20%. That is what it is trying to say. Qualifying amount for BADR, correct? Have a look. Qualifying asset for BADR. What are the assets? Whole or substantial part of the business is sold, owned minimum for 2 years. It can be for individual or partnership. If the whole business has ceased, correct? Right? In that case, individual or partner and the business is owned for minimum 2 years and sold within 3 years after cessation, right? Investment are not BADR asset, correct? So that much portion will not be allowed. And disposal of share or trading company owned for minimum 2 years. Individual hold at least 5% of the share of the company and part or full-time employee of the company for 2 years. All 4 or 5 situations fulfilled or conditions fulfilled, you can say that BADR is applicable. Now have a look at note of BADR, calculation of BADR and investor relief, correct? When BADR, whenever you're doing calculation in individual of BADR and non-BADR, like you do residential property and normal asset, same thing you do BADR asset and other assets, correct? BADR assets will always be taxed at what? 10%. Non-BADR at 20%, correct? Right? So first taxation will happen of BADR. Whenever BADR qualifying and non-qualifying income come up together, always tax qualifying income first, that is BADR qualifying, and then tax non-qualifying BADR second. Investment assets will not be considered as qualifying for BADR, correct? So you cannot consider CG on investment assets, right? Goodwill is a qualifying BADR asset. AEA and brought forward losses, correct? First preference given to non-qualifying. So whenever you are using AEA in an individual, correct? AEA and brought forward losses, first preference will be given to non-qualifying BADR, right? And second preference will be given to qualifying BADR, right? BADR losses, right, to be netted off against BADR gains. That is BADR for you, right? So BADR what? All assets sold, business sold, minus the cost to acquisition, you will get CG. CG pay what? Tell me. Full BADR tax at 10%. But if it is a investment, correct, that will be non-qualifying BADR, right? So that is how it will happen. Then BADR, non-qualifying BADR, one example is there. Then investor relief somewhere you will have. Have a look. This goodwill is there, correct? So CG of investment will go in what? Non-BADR, right? Investor relief is also same thing. Investor relief has 3 or 4 important clauses. CG will be taxed at 10%. Lifetime limit is 10 million, correct? Then you have investor relief on what? Qualifying shares, unquoted shares plus, if those are unquoted shares, subscribe for shares after 17 March 2016, held for at least 3 years and not an employee or director of the company. In this case, what? Investor relief will apply. Investor relief, simply you have to learn what? 4 conditions, right? Then rollover relief is there. Rollover relief. If there are three assets, goodwill, land and building, fixed plant and machinery, correct? If you sell any of the asset and buy a what? Same asset. That means you sell a land and building, buy a land and building, correct? In that case, right? If you buy the replacement asset, so you sold one asset and bought the replacement asset 12 months before or 36 months after sale of qualifying asset, both asset that is qualifying main and replacement asset should be assets that are used for business use. Gain can be rolled over for number of times. Have a look. There is a question here. So I bought an asset for 100,000, sold it for 200,000, full business use asset. I bought another what? Land and building, right, for 200,000, correct? So I reinvested the full 200,000 here. Have a look. Full 200,000 reinvested here. So the CG on this 100,000 will be fully rolled over, correct? And will be deducted from the cost of acquisition of the second land and building, and the revised base cost will be such, correct? Then if full reinvestment, or if let's say part of the asset is, this is only 70% business use, then you will make two parts of this, right? And you will have what? Rollover relief only to the part that is applicable, correct? From the 100,000, you will deduct the non-business part here, and only 40,000 will be allowable. But this I have not seen a lot of time being asked in exam, correct? So I'll take this. If reinvestment fully does not happen, have a look. Instead of 200,000, you only invest 150,000. So this 50,000 will be directly CG, correct? And 50,000 will be rolled over. Rollover relief. Very simple if you look at the questions. But when it comes to what? Tell me. If land and building is sold and plant and machinery is purchased, then rollover does not happen. Freezing of chargeable gains happen. The chargeable gain gets frozen, right? And it will be taxable when this plant and machinery is sold, or it can be what? Taxed when a replacement asset is ceased to be used. That means plant and machinery ceases to be used for business, or 10 years from the acquisition of replacement asset, whichever is earlier, correct? So have a look. I have taken a question, right? You take fixed plant and machinery. Here, freezing the gain happens. This no revised base cost. Cost of acquisition will be 200,000 only. When this fixed plant and machinery is sold, let's say, or 10 months have 10 years have passed, or it ceases to be in business, correct? Then this gain frozen will get unfreezed here. So there are three questions I have taken on this. You can have a look at it. Then, let's say, now what happens? You sold land and building, bought fixed plant and machinery, and you did freezing of gain and all that, correct? But within that next 3 years period, correct? You also bought another what? Land and building, correct? Then can this frozen gain be rolled over? Yes. Have a look. Non-depreciating asset, first reinvestment in depreciating asset, and then second reinvestment. So what did I do? Here gain was frozen. In fixed plant and machinery, I did not deduct. But when I bought this second land and building, the rollover relief was what? Rolled over, and the revised base cost. So land and building sold, depreciating asset bought, and again somewhere land and building bought, then the frozen gain can be rolled over. I have not seen a lot of questions being asked on this. Then there is something called as holdover relief. Whenever Mr. A gives anything to Mr. B, we have seen that it is a fully taxable event. Market value of what asset is taken, all that is done, and CG is taxable. But if Mr. A and Mr. B decide that they want to hold over the relief, then what they can do? This CG will be held over and taxed in the hands of Mr. B. That is what? From his cost of acquisition, the holdover relief will be deducted. He will have a revised base cost. When he sells it, he will have a cost of acquisition of revised base cost, right? But holdover relief, what are the qualifying asset? Asset that can be gifted in a holdover relief. Asset used in trade of donor and donor's personal company. Unquoted shares and securities of any trading company. Quoted shares and securities of donor's personal trading company. Whenever I say personal trading company, it has to be that donor has to hold more than 5% of share capital, right? Unquoted or quoted company may you have to do one question, specific question is there, right? Whenever you are transferring what? Shares, correct, of quoted or unquoted company, right? The section will say when you are doing holdover relief, do CG into market value of chargeable business asset divided by market value of what? Chargeable asset. Your goodwill will not be an eligible chargeable asset. So asset eligible for holdover relief, these are chargeable assets, correct? All assets which what? Tell me, all assets which lead to CG when sold or transferred, correct? But will not be included, but does not include car, inventory, receivable, cash, etc. Chargeable business assets which CG is there, correct? But what? Tell me. They are not business asset. Investment is not a business asset, right? So it will not be included. So no minimum holding period required. You don't need to be employee of company. Everything is there. So have a look. CG before relief is 250. There was one question that is there. You can have a look at that question, correct? That can be done. I think with this reliefs also get over, correct? Now let me give you a sneak peek into the paper writing part. So your paper would be, how will it be? Tell me. Okay. Simply you have what? Tell me. Three parts. Section A, Section B, and Section C, correct? Section A has 15 MCQs. I cannot predict this, correct? Section B has 15 MCQs, correct? Section C, but here there are 3 case studies. Section C has 3 questions. 15, 15, 10, correct? Generally, I have seen, right? Section A, 15 MCQs. I am not at liberty to what? Tell me. Discuss this, or I would say this would come, that would come, because it is one of the most unpredictable part of the paper. But let's say time management, if you have to do, then these 15 MCQs, you may take 1 to 2 minutes, correct? Let's say 1.5 minute per MCQ, correct? So logically, how much time will be used here? Tell me. Somewhere around how many? 20? 2.5, no? How much? 22, or let's say 25 minutes. Can I say 25 minutes for the first 15 MCQs? In this also, what I'm trying to say, there will be 3 types of MCQs, correct? One will be very easy, one will be moderate, and one will be difficult. Am I on the right track? Tell me. Out of the 15, generally you have 5 very easy MCQs, 5 medium, and 5 moderate. For the easy MCQs, generally you will take 1 minute only, or 2 minutes max. For this medium, you will take around so again 15 MCQs. I was saying 3 parts: easy, medium, difficult. 5, 5, 5 MCQs. 2 minutes here, probably 3 minutes here, and 5 minutes here. So find out how much will be the total time that will be required. This is 10 minutes, correct? 15 minutes and 5 minutes थोड़ा ज़्यादा हो गया. Let's say this is, or I could say both these, medium and this, could require 3 minutes per. So 10 into 30 minutes, that means you will require around 40 minutes here, correct? Here what you will do, which all MCQs you have answered, correct? And you are not very confident, flag those questions, correct? Then come to section B, correct? Section B also has 3 case studies, correct? In that also you will have easy, medium, and what? If you have seen here 2 questions, one IST, one VAT, you will 100% see one IST, one VAT question there, right? At least one IST or one VAT question will always be there, right? That means out of the 3, one will be IST or VAT, or there can be 2, one IST and one VAT both, correct? Here also first or second MCQ after the if you have noticed, there is a case study. After that, first or second is always a practical based MCQ. Have you seen it? Tell me. First or second will be calculation of something, correct? Logically, a lot of students don't have problem here. So 2 minutes, correct? And easy wala 2 minutes, this 3 minutes, and let's say 4 minutes, correct? 5, 5, and 5, correct? So 10 minutes, 15 minutes, and 20 minutes. So how much is the total time you will require? Tell me. 25 and 20, 45 minutes. Plus, I'll give you additional 10 minutes because you'll have to read the question, correct? So you are done with how many minutes? Tell me. Obviously, you will flag the question here. So you will be left with how many minutes now? Tell me. 85 to 90 minutes done. 1.5 hour done. 60 marks done. Now, when you enter section C, correct? On an average, you have 3 questions, right? One question surely going to be employment. 100%. Take it from me in writing, 100% it is going to be what? Tell me. Employment. Right? So 15, 15 and 10. One question so you will do easily. Correct? Let me give you 2 minutes per mark. Even if I do 30, 30 and 20 minutes. 30 minutes here, 30 minutes here and 20 minutes here. So how much is it? Tell me. 80 minutes plus 90 minutes. Still do you have 10 minutes left? Tell me.
Yes.
But what you should do? You should not use this 10 minutes here. I'll tell you. Once you are done with section B, no, before entering section C, whatever flags you have placed, 5-10 minutes, go through all the flags once, right? Don't even leave a single question unanswered. If you leave a single question also unanswered, right? Faculties like me will haunt you in your dreams, because even if you have taken a guess and given an answer, right? Probability of 25% of the answer getting right, because you have 4 options. Probability was what? 25% of it being right. Okay. So tell me, never leave even a single question. So what you do? By the end of section B, if you are able to figure out something in section A, what you had flagged, complete that. Section B flagged, complete that. Because I have seen a lot of times, right? And don't even leave before starting section C. All 30 MCQs have to be answered, have to be answered, have to be answered. There is no compromise or no reason that you can give for not attempting any question. You have done 3 months, 6 months, whatever months you are doing UPA tax, correct? You will have what options, correct? You will have a out and out idea of what is asked, correct? Then coming to section C, right? First, you would do employment ka question, correct? Always start with employment ka question, one of the easiest question. Then if there is CG or self-employment, I would say one is self-employment or corporation tax, and one is CG and some other topics, losses or something. First go with CG because CG is comparatively easier. But if it is relief, then leave that aside for some time. Then you can do self-employment or corporation tax question, and then at the end, this 10 marker that is there, right? And see, now once you are done with section A and B, you have closed the flags, right? You are tension free. So you till the last minute, you can write these 3 questions. Correct? You can follow formats that are given. You can follow what things that are given in your syllabus, and you have notes, correct? You can write the theory. Generally, I have not seen coming up in exam, but still now what is the trend? 15 and 2 marks, or 13 and 13 plus 2, 12 plus 3, something like this comes up. 10 may you have 7 and 3 or 8 and 2. Some date asked, UK tax admin date, or some interest calculation or something of that sort is asked. Other than that, I have not seen a lot come up in the exam, right? This is your paper management skills, how you should manage your paper, right? While writing section C, some question that is unanswered or maybe answered but you have flagged, you feel like, boss, I still don't remember, or you are able to, while you're writing your 15 marker second question, correct? You click or something clicks in your brain that, boss, I know this question. In that case, go back, revisit that question and complete it, and then go back to section C. Has happened and will happen in exam, correct? That is how things work out. See whether you are okay with this. Tell me. Can I go ahead? Anything else that you want to ask specifically for your paper? Tell me. Tell me.
No, sir.
No, sir.
So then, do you want me to do tax admin or you can skip it? Tell me.
Skip, sir.
It's okay if we skip.
Right? Chalo. Then with this, I think you are fully prepared for exam. All the best for everyone for your exams, right? Whatever is your exam, if you want to, I'll probably call you for how the exam went, right? You can always share that and stay confident from now. Now see, 1, 2, 3, 3 days are there, correct? Fourth is your exam. Try to stay as healthy as possible. Don't do unnecessary night, 15 hours, 16 hours, and then damaging your health, correct? Because at the end, if everything you know, but physically, mentally you are prepared, but physically, if your body does not allow you to reach the exam hall, correct? There's no point. Tell me, preparing so much and going so hard with your preparations, correct? So take care
Yes,
of
sir.
your health. Health is
Yes.
of utter importance. Your food for next 3 days has to be very mild, correct? Don't have something very oily or something which may damage your throat or some other tell me problem might appear, right? So these may sound like very small things, but has happened with a lot of students, right? Don't go outside to roam too much, correct? It may so happen right now with situation, the changing weather, the health might go back, correct? So take care of all these things. Anything else if you feel in the next 3 days? I know some of you have sent some messages. I'll reply today for sure. Okay. Chalo then. Take care. All the best for your exams. Right.
Thank you, sir.
Bye bye.
Thank you so much, sir.
Thank you,
Sir, I
sir.
have texted you some doubts in
Yeah, yeah.
between.
I'll check it out. Okay. Yes. Welcome, Mohammed. Okay. Chalo. Bye bye, guys. Neha, bye. Everybody, bye.
Bye, sir.
Thank you so much, sir, for teaching so well.
Yes. Welcome, buddy. Bye.